deep insights in market cycles and expertise in value investing. His famous memos are widely read by top investors, including Warren Buffett. Please welcome Howard Marks and Mahalakshmi Narayanaswamy of Moneycontrol for this conversation.
Thank you so much, Sonal, and thanks so much, Howard, for this incredible opportunity to talk to us. I won't waste even 10 seconds talking about anything else, straight diving into the questions. And I just picked up something you said in your latest memo, and I read this out. There were only 4 times in the history of S&P 500 when it returned 20% or more for 2 years in a row. In 3 of those 4 instances, the index declined in the subsequent 2-year period. The exception was 1995 to 98, when the powerful TMT bubble caused the decline to be delayed until 2000, but then the index lost almost 40% in the 3 years later. In the last 2 years, it's happened for the 5th time. The S&P 500 was 26% up in 2023 and 25% in 2024, marking the 2 best year stretch since 97-98. What is different this time, in your view? I know that you hate to do predictions, but probabilistically speaking, it looks like stocks will underperform bonds, inflation, and cash over the rest of the decade. What's your view?
Well, I think if you accept the past numbers, and it's dangerous not to, then you have to accept the fact that today's valuations imply modest returns over the coming decade. One investment bank said 3% a year in early November, another said 5.5%. Certainly, the historic average return on the S&P has been 10, but we're at an above average valuation. We expect that we'll have below average prospective returns. What's different this time, if anything, is the constitution of the S&P 500. We have the Magnificent Seven. It appears that some of them, or if not all, are some of the greatest companies we've ever seen. Better than the companies that led the S&P in the past. When I started work, reported for duty at First National City Bank in September of 1969, we were investing in the Nifty 50. And those were the magnificent companies of their day, selling at much higher PE than today. Some of them didn't last very long. And if you held those stocks for 5 years, you lost more than 90% of your money. These look like better companies to me, although I'm no expert. I'm not an equity person. I'm not a tech person. Selling at lower PE ratios. So, there's always an argument this time is different. Usually it's not different, but sometimes it is. This could be one of the times when it's different. But I think that it's hard to argue that the S&P is positioned for above average returns, and maybe not today even for average returns.
Fair enough. I was just about to come to that. Do you think the craze around AI today is reminiscent of the Nifty 50 era?
Well, it's reminiscent in the sense that the Nifty 50 era was based on the new thing. It was dry copying for Xerox. It was computing power for IBM. Super drugs for Merck and Lilly. Instant photography for Polaroid, and so forth. And most excesses in the markets, I hesitate to use the word bubble, but I will. Most bubbles are by necessity built around something new, something where there's no precedent, permitting the imagination to fire. and confidence to reach escape velocity. In 1999, we had the internet, and people said the internet will change the world. Guess what? The internet did change the world. They were right. But they were wrong to value the companies as they did. They were wrong to assume the persistence of the companies that they did. And most of the companies that went public in the TMT bubble of 98, 99 are worthless today. So now we have another new thing, the AI. AI is expected to change the world. I'm no expert. I assume it will. Nobody knows how. Certainly nobody knows when or to what extent. I think it's going to have a profound impact. But again, assumptions are being made about persistence and leadership. I can't dispel them. I can't endorse them. I only say they require attention.
Fair enough. But is it some kind of a warning signal, you would say, for investors, because the Magnificent Seven have contributed to more than 40% of returns for 2023 as well as 2024?
Again, numbers that on their face are a yellow light at minimum. On the other hand, I think that the experts, and certainly the optimistic experts, would say wonderful companies at reasonable PE ratios. So the mere fact that they're up isn't troublesome if, in fact, they are indeed great companies at reasonable prices. Somebody else will have to tell me whether that's true today, and of course, we'll get the judgment of the market in the coming years.
Right. Moving on to interest rates, something you've said recently. Interest rates will not return to ultra-low levels, nor will they continue to decline. Why do you say that? High interest rates in the US, I also want to, just say that high interest rates in the US have historically been correlated with low stock returns. What's your take?
First of all, I want to clarify. Today's interest rates are not high. Everybody says to me, oh, you're saying that rates will be higher for longer. Higher than they have been in recent years.
Right.
But not high in the absolute. I refer to a chart of the Fed funds rate for the last 70 years, most of which I've seen, and it averages just under 5%. Today's interest rate is below average on that basis, and I imagine will be brought down a bit in the coming years. But we went through a period from the beginning of 2009, when the Fed took the Fed funds rate to zero to fight the global financial crisis, until the end of 2021, when the Fed gave up on inflation being transitory and concluded that it had to raise rates to fight inflation. Over that 13-year period, even I was surprised to learn when I studied it that the Fed funds rate was zero most of the time and averaged about 0.5%. So that's the abnormality.
Right.
That was abnormal. I merely think we're not going back to that abnormality. Today's rates are quite normal, and I see no reason why we shouldn't stay here.
It seems like the markets are very stuck up on, decline in interest rates as a trigger for stock prices to go up. Is that expectation sort of misplaced? You think this is a new normal, whether there are pulls and pressures on monetary front or fiscal front, these interest rates are okay for the US economy to continue to fare the way they are?
I think that today's rates are within the band of normalcy. I think they can stay there. Our economy in the U.S. is functioning well. It's not booming, and thus it does not necessitate a bust. It's not sluggish. It's performing well. And I think that today's rates, or rates a little bit lower, will be perfectly appropriate for that. Our economy does not need stimulus by taking rates way down. It does not have to be restrained from overheating by taking rates way up. I think rates can stay here, and I think they're quite reasonable.
Sure. History doesn't repeat itself, but it often rhymes, said Mark Twain. What is history teaching us now?
Well, of course, today isn't history yet, and when today becomes history several years from now, we'll learn its lessons. The important message from that quote from Mark Twain, which I think is one of the most important quotations in my world, is that the details of history change. The events change, the reasons for them change, the results of them change, but certain things do persist and rhyme, if you will, from year to year and generation to generation. And most of those things, or I should say many of those things, are behavioral. And, people will always get overexcited when things go well and take asset prices too high. And then when things come off, they'll get too depressed and they'll take prices too low. These are the things that rhyme from cycle to cycle, and we have to be alert to them. When things are going well, people will lever up their enterprises in order to magnify the gains. And they'll do that because they underrate the probability of losses, and they forget about the potential of leverage to magnify losses instead of gains. But it works both ways. This is another lesson that repeats from generation to generation and usually has to be relearned from generation to generation because it's a lesson that's forgotten in good times. So I believe we'll always have cycles. Optimism will be taken to excess. Bad deals will be done when spirits are too positive, and those will be exposed in slower times through losses. Now, you asked what will we learn from today? Today, I think, as I say, the economy is performing well. The prices are generous, let's say high. In my memo of 2 months ago on Bubble Watch, I said lofty but not nutty, and I stick with that. I don't see massive psychological excesses today. And of course, the events of the last days and weeks have even reduced the enthusiasm further. But I think that, we know that the PE ratio on the S&P 500 is at an above average level, maybe warranted based on the excellence of the companies in it, or maybe not, but certainly not underpriced. And certainly not, in my opinion, a time for unusual aggressiveness.
Sure. This question may sound like it's a bit of an exaggeration, but probably it's not. Is value investing extinct? Buffett says that all investing is value investing, but if the essence of value investing is buying assets for less than what it is worth, we haven't seen anything close to that in Indian equities for the past 2 years, not in US, perhaps in China. What would you say?
It's a very complex subject. I can't do it justice, and if I try, you'll run out of patience with me. But I wrote a memo in January 21, and all the memos are available on the Oaktree Capital website under the heading of Insights. It was called Something of Value. It ensued from discussions I had with my son Andrew when he and his family moved in with my wife and me during the pandemic. He's an investor. I'm an investor. We actively debated the question of value investing. Now, value investing, to me, means not thinking of investing as pieces of paper that you trade daily for profit, but thinking of an enterprise that you want to be an owner of. and are willing to hold for the long term. And, you know, if you're looking at a business and thinking about whether you want to buy a share of that business and hold it for the long term, you're probably going to want to make sure that the price is reasonable. And I think all of that makes sense. Now, all semantics eventually get taken to an extreme. And it morphed into value investing with a capital V. And what value investing with a capital V was taken to mean was disregard for the future, concentration on the present, insisting on discount valuation parameters. Andrew insists, I accepted his contention that doesn't have to be the definition of value. That's too extreme. It's too dichotomous, separated from growth. And people like to dichotomize and codify things very formalistically. But I think, you know, the way you're using it, let's say you're using it in a sense kind of in the middle. And, you know, the world tends to think that growth stocks are companies with high rates of growth projected into the future, and value stocks are companies with modest growth rates with an emphasis on the present. I think if you think about it that way, the lesson is that since, quote, growth investing is future-oriented, it is accepted more readily in optimistic times. And when people turn less optimistic and are less willing to credit the future with great events, then they become a little more cautious and they want value in the here and now. So they look at what are called value stocks. So I think if you look, the most part, not precisely, but I think that growth investing value described that way rises when people are optimistic, and value does better when people are defensive or pessimistic. Well, the answer is that people haven't been defensive or pessimistic in a long time. You know, the last serious prolonged negative incident we had was the global financial crisis, which started in 2008, so it's almost 17 years old. We had something called the pandemic in 2020. It was a very serious event. A lot of people lost their lives, but the markets and the economies kind of shrugged it off in short order. So it didn't really last, and it didn't have a profound effect. So I think that if you look, you would conclude that for the most part, optimism has prevailed for 17 years, or at least 16, or maybe 15, and that's a big part of why what you call growth, what most people call growth, has done so well. There will be a time for value, a time when people say, well, those stocks are being valued very highly because people say they have a bright future, but I'm worried about the future. And I think people will return. It's not growth of value. It's that these sorts of companies have dominated the calculation of the S&P 500 for years. And the trend towards passive and index investing has amplified the power of the S&P companies relative to the non-S&P. And I think that's been an important contributor to the success of, you know, there's an overlap, if you have a Venn diagram, an overlap between growth and S&P. They're not the same things definitionally, but there's a coincidence. And I think that indexation and passive investing have directed a lot of money towards, it happens, the growth aspects of the S&P. It's hard to know when it's going to stop, but you would think that if the S&P companies appreciate a lot longer and the other companies appreciate much less, you would think that eventually the S&P companies will become so rich that that they can't keep outperforming. But my answer to that is same as my answer to many things. We'll see.
Right. So there is also a contrary logic that some people argue. One argument in favor of high price multiples and strong equity valuations, especially in the US, is that industries are consolidating, and we're not talking about just new tech or AI, but even traditional industries, which is making companies significantly more efficient and profitable. Corporate profitability in America is at a historic high at 11.5%. Of course, real wages are at a historic low. That's a different matter altogether. Do you think this is good enough reason for equity valuations to sustain at elevated levels, despite higher interest rates?
I don't have an answer to your question, but what I'd like to do, I'd like to discuss the form of your question for the benefit of the audience. First of all, it's dangerous when you assess the appropriateness of the market pricing based on one factor at a time, because there are so many factors that matter. People tend to say, well, there's more concentration, there's more profitability, companies are better today, it merits a higher ratio. That's the line of argumentation. Well, I would say maybe. The question is, how much better are the companies? How much better do people assume they are? Are their assumptions correct? How much superiority is priced in to the prices today? Is that degree of superiority appropriate? So, better companies, higher multiples, easy to say, but hard to be sure that the increase in superiority and the increase in valuations are appropriate for each other.
Sure. Howard, how do you think Trump's policies are likely to reshape business and financial markets globally? For US particularly, do you think tariff-induced inflation, the cut in government jobs, poses a real threat to US demand and therefore economic growth? We've been talking about a recession for the past 3 years. It never happened. Growth has been fairly buoyant. What is your view on that? And secondly, what should global investors be watchful of?
Well, the overarching thing that everybody should keep in mind is that Donald Trump is a pro-business president. And, there's an old saying from my youth that what's good for General Motors is good for America. And, I would say in general, this is a vast overgeneralization, the Republicans would agree and the Democrats would disagree. And certainly today there's a whole element in the Democratic Party which thinks that business and free enterprise aren't such a great thing. Donald Trump thinks they are, and he will try very hard to make business do well and American business do especially well. But some of the actions can have short-term negative effects. For example, the tariffs, which he thinks will, discourage imports and encourage exports and produce revenues for the government to balance the budget. All of that seems like great things, but they should have an inflationary impact. That's just one example. I think his policies taken to their logical extreme, and we don't know how far they'll be taken, would end up in a lower level of globalization than we otherwise would have seen. Globalization, in my opinion, is a wonderful force. It raises boats all around the world. It lets everybody and every nation do the things they do best, And everybody in the world benefits from that degree of specialization and division of labor. If we globalize less, I think the whole pie shrinks. Of course, I think it's fair to say that Donald Trump is less concerned with the size of the whole pie than the size of America's slice of the pie. But, you know, when you introduce inflationary forces, which of course could necessitate higher interest rates to cool off the inflation, which would be bad for the economy. When you reduce the level of globalization, when you introduce high levels of uncertainty, I think those things together are tough on business collectively and tough on investors. So, where Trump is going to go with his ideas, how he will implement them, and how good a job of the implementation he does, all those things remain to be seen. But ironically, you have a highly pro-business president who has introduced a lot of questions along the lines I just enumerated.
Sure. China has been waiting for a recovery for nearly 3 years now. It's not happened. To you, Oaktree, what is your view on China? And qualitatively speaking, how do you compare India vis-a-vis China?
Well, let me say up front that I'm not an expert on either. I travel, I visit India, and by the way, let me say, I think it's coincidentally ironic, but here I am in India today, but not with you in person. I'm in Hyderabad for the opening of Oaktree's Hyderabad office that we're all very excited about. Unfortunately, I can't be with you in Mumbai today. But I'm no expert on China. I'm no expert on India. I travel. I go on impressions. I read. You probably know more than I do. I only know what I read. Look, I think that China has great potential. It has great human resources, educational resources. It's very purposeful, and it is highly motivated to become the biggest economy in the world. It has problems of a declining population, low birth rate, and the high functioning private sector operates alongside the state-owned enterprises, which generally I think don't do as well for the economy as the private sector. There's kind of an unusual, what might you say, a strange bedfellows there. But you know, China has done very well for the last 30 plus years. If they settle on the right policies, it can continue to do well. But it has to make up its mind about whether it's going to be truly socialist or encourage the private sector. India, on the other hand, has a growing population, and coming off a low base, it has incredible opportunities. And of course, you have a very constructive government right now, which is trying to move this country ahead. My last visit here was exactly 8 years ago. I feel a different energy today, and India seems very positive. But of course, you have a large sector of this large and growing population that you have to move into the middle class. You have to educate with skills. You have to get jobs for, and you have to increase your capital base. Different challenges, but hard for me to say better or worse right now, especially because of the geopolitical overtones. Many people have described China as uninvestable. People want, I think people inherently want, you know, the term the BRICS was coined 30 or 35 years ago, and I think everybody who's optimistic wants to have some money in some subset of the BRICS. I think India seems to be a great candidate for that right now. And in fact, of course, India has benefited from the fact that so many people see China in a less positive light today. I'm optimistic on India. Very glad to be here, both physically, myself, and with our office and with our lending activities. And I'd feel a lot worse if we were not participating in India as we are today.
Sure. For the benefit of our audience, what advice do you have for people out here to become second-order thinkers, second-level thinkers?
Well, the first piece of advice I have is that to be a superior investor, you have to achieve what I call second-level thinking, which is thinking different from the herd and better. Not easy. By the way, not everybody can be different from the herd and better. Most people will be in the herd and know better. Some people will be worse. So it's not easy to be different from the herd and better. And if you can't, then you shouldn't try any fancy shots. You should just settle for participating in the growing Indian miracle. And my own guess is that being an average participant in India in the coming decade will be a pretty good thing. To be an above average participant, to have higher returns than the averages, you have to have a knowledge advantage. And it takes a lot of hard work and understanding of companies and markets to achieve that. If that's people's goal, if they want to be above average participants in these markets, they have to achieve that. They have to do the work. They have to achieve the understanding, the insight. I can't tell them how to do that. I can only tell them about the importance of doing it. And to be a second level thinker, to be an above average investor, you have to achieve a rare higher level of insight and sophistication. And you have to understand that if you have the same data, you see things the same, have the same thought process, engage in the same actions, you'll be an average participant. Nothing wrong with that. But if you want to be above average, you have to excel in one or more of those elements, and it's hard. And my most fervent advice to our audience today is that if you aspire to be above average, go for it. Put in the work. Try to achieve that level of insight. But the more important thing is participate in this economy and in this market. I don't mean buy today. I mean, you don't want to, in my opinion, you don't want to miss out on the India of the next 10 years. And if you engage in market timing, in, out, buy, sell, you just might miss it, And some of the most important lessons are based in humility and an understanding of the limitations on what we can achieve. And an example of that is, one of my sayings is, if you wait long enough at a bus stop, you'll catch a bus. If you run from bus stop to bus stop to bus stop, you may never catch a bus. So, mere hyperactivity, merely trying harder, is not necessarily the route to success. A lower level activity combined with a higher level of thought might be the way to go.
Sure. One last question, Howard. Buffett talks about ovarian lottery. A big part of his success was because he was born a white male in America at that time. Today, if you were to pick a country, US, China, India, or any other country, what would you think will qualify as ovarian lottery, number one?
Well, I don't know who's going to win the race among those three countries. The greatest luck is to be born at this time rather than 200 years ago, and to have access to education. And, you know, you can get a great education in all three countries. And I'm fortunate that as I travel in all three countries, I meet the students at the leading educational institutions. And they're the ones who are winning the lottery today. The great news is, I was born almost 80 years ago. Buffett was born almost 95 years ago. Our lottery victory was to be born a white male in America in the mid-20th century. Today, you don't have to have been born a white male in America. Just participate, just living in any of our three countries, if you can access the educational system and work hard, you can have success. It's not nearly as dependent on your gender, race, or location.
Thank you so much. On that note, Howard, that's all we have time for. But thank you so much for this opportunity. It's been a real privilege and honor. Thank you.
Well, thank you for your good questions.
All right. Thank you for that. Global investing is being reshaped in real time with Trumponomics, a mix of tariffs, tax, and America First policies redefining the capital allocation. Now, as manufacturing, reshoring, trade alliance shifts, and deglobalization unfold, investors must adapt to a world where old playbooks no longer apply. So what does this mean for emerging markets like India? Will global liquidity favor Indian equities, or will protectionist policy shift capital elsewhere? Let me welcome back Mahalakshmi on stage for a conversation with our special guest. It's Mark Coombs, CEO of Ashmore Group, who has flown in this morning from London to give us his review. Please welcome on board with a warm round of applause.
First of all, thank you so much, Mark, for, again, this incredible opportunity. You've flown in especially for our event, and this is a premier platform, and this is our first time, and doubly happy to have you here. Before I dive into the questions, since the time you started Ashmore, has this been the toughest phase for emerging markets?
I think it depends on which market you are. Emerging markets
as a whole, I'm saying as a whole.
Yeah, emerging markets are not the same. They're different. They're different sizes, different aspects. I think it's harder for some than it was, and it's easier for some than it was. As a whole, there were more people attracted to emerging markets through the 2000s. They followed, if you like, the superior growth rates and the opportunities. Some of the conflict that's gone on since 2021, 22 has made people, certainly the Americans, think that they're a bit concerned about being outside America, so that's reduced the natural flow to emerging markets. But within emerging markets, I think growth is superior and there's a lot going on. And for our businesses, which are based on domestic markets, not just international flows, I think times are not too bad, actually.
Okay. So first things first, what is your view on Donald Trump's policies? There has been a lot of back and forth in terms of tariff. First he announced some tariffs, then it was deferred, then it is back on the table. What was talked about with respect to China, 60% tariff, we are nowhere close to that. Some of those fears seem to be receding, some other are coming back to the table. What's your view?
Yeah, I think the problem with policy is that people like certainty. Investors like certainty and clarity. And so at the moment we've got a situation where nobody is quite sure what degree of tariff may or may not be charged on who and for what kind of sectors. So in terms of the idea of tariff, I mean, there was a world years ago when it was all tariff and no tax. The tariff was the tax. That's what happened in terms of the US, and that's a little bit how we believe Donald Trump is thinking. I think things need to settle down. We need to understand at what point tariffs are set to come into force and remain with a degree of permanency as opposed to a geopolitical negotiating tool. So I think we need a little bit of time to see how it all works out. I mean, there is no question that if you're trying to drop personal tax rates in the US and you're trying to reduce the deficit, there's a series of things you can do. And if you can find thoughtful ways to tariff certain trade flows in a relatively non-inflationary way, you can see why that's attractive to an incoming president. The devil is in the detail. Can you do that?
And what do you think will be the impact with respect to China and India? You know, there was this thought process that if there are high tariffs on China, then maybe India will benefit because a lot of sourcing can happen from India. But the counterpoint to that is if there are lots of overcapacities in China, that will sort of flood the rest of the markets, and India will actually not benefit from that.
Yeah, that's a really good question. I mean, you see that fear moving around with flow. If you think about not just domestic investors in India, but you think about global investors trying to pick the winner between India and China. I think it's going to depend on a few things. I think if you're the American president that currently sits there, you would regard China as your greatest competition. You may or may not be right in the long term, but clearly China plans to be the biggest economy in the world and has made no bones about it and plans to exercise that any way that it can over the long term. If you're not a Chinese investor, that makes it quite a difficult place to invest from time to time because you're not certain about policy. It is relatively opaque in the way that it operates. Yes, it's big. It has some big structural challenges at the minute, not least massive youth unemployment. And it's going through a difficult reset. Does it long-term do better than it is now? Almost certainly. Is it in the price? Some people would say yes. There's been a big shift out of Indian equity into Chinese equity, for example, having been the other way around for a couple of years. I think the way we think about it is, and I said this right at the start, you want to be in countries that are that you're relatively certain of what the policy is. Business will work it out. If we know what the rules are, and as long as there are rules and a rule of law to enforce them, we'll figure out how to invest and where to invest. So we can absorb a tariff here, a tax rate there, a particular incentive to stimulate tech in that place or not in the other place. But we require certainty. So for me, in terms of long-term structural investing, I want a place that has that and where capital can flow relatively freely. The challenge for non-Chinese investors now looking into China is, yes, the stock market may be relatively cheap and one can trade that, but to be a very long-term structural investor is quite difficult if you're not certain what the rules are going to be if you're not Chinese and if you're from overseas. So what I think you're seeing at the minute is the relative attractiveness of India. Geopolitically we can get into, but even economically, where there's certainty of policy and there's some structural reform going on here and the whole move to digitalization and bringing more people into the net, it's a very attractive place to invest if you were doing a straight one-to-one comparison, not just on scale, but on certainty and on terms of rules under which you can operate and invest for the long term. As investors, we can trade everything. That's all jolly good fun. But what really helps us is not day-to-day and second-to-second trading, but being able to commit capital for the really long term and then trade around the margins. But you want to be long and right and then trade around the margins. What you don't want to do is have to keep going, oh my goodness, they're going to shut the gates on capital flows, or They're going to start saying they don't want foreign companies, or they're going to start saying healthcare should no longer be a private sector business. These are things not happening in India, but they are the risk in China. So for me, structurally, India is more attractive long term. China's, of course, massive and will be the biggest global economy. How you play that is much trickier without certainty.
Okay, this is also a thought actually a lot of other investors echo, and I often find this. Most foreign investors, at least we speak to, seem to be saying that we are good to invest in China as a tactical opportunity. There might be a bounce and we'd want to capture that. But because we've burnt our fingers over the last 10 years, the Chinese markets have gone nowhere, paltry returns on equities. So big money is not going back to China. So are we just extrapolating? Are we prisoners of, a long period of outperformance? Are we underestimating China's ability to come back and score in the next decade? Will that be a mistake?
I think there's a lot in that question. We've been investing for a really long time, and we've been investing in China for a really long time, and India, and in different ways and at different times. And you've always have the issue in China, and at some points you're concerned about having that in India or in anywhere, in the UK. Is it a level playing field with the state? Am I going to be competing with the public sector, and am I going to be able to play in the right way? And for a long period of time in China, you were always concerned, was subsidy going to SOEs? Was there a problem with SOEs? You invested private capital for the long run. Could you make a good return on it because you were going to get structurally beaten by the domestic investor or the domestic party? So that was a big concern for us in terms of China. I think that concern still exists. I think what is going to happen, though, the sheer numbers of people, the sheer scale of the market, means that the market will over time grow. Yes, it'll have its moments where you have a population trend that isn't so fabulous at the minute. They'll fix that. Whether it's 25 years away or not, that is going to get fixed. It's big. There's lots of people. There's going to be lots of consumption. So I don't think you can afford to ignore it. It is true that one has to take, I would say, a much more tactical view of China today, and you can, because the markets are liquid enough, than you might have done 20 years ago when you said, I've just got to be in China. I mean, there are people that are doing just fine, foreign investors in China. There are sides of the financial sector that are growing. It's just, it's more tempting to be tactical.
Sure. You talked about Indian markets and some of the allure, but somehow over the last 6 months, we've seen such accelerated pace of foreign selling. It just seems to be unrelenting. Nearly $26 billion has moved out of Indian equities alone in the last 6 months. Now, we have a long structural story, there is certainty with respect to policy, then why this level of exodus?
Yeah, because everybody's not a structural investor. Unfortunately, or fortunately, depending on how you want to look at it, India is regarded as up there as one of the most significant economies in the world in the future over the next 10, 20, 25 years. And it is a natural choice for big global investors to look for bigger markets to invest in. If we just leave the domestic side, the domestic investors out for the minute. So what happens is when people get excited, they look for a big market to play in. And if you think about it, what you're seeing now, the last 5 or 6 months of foreign capital disappearing from India, the equity market in particular, the daily traded equity market where they can change their minds, was really about two things. It was about, had India run too far? And based on very long-term numbers, you could say that the level of PE, etc., was high in terms of a 25, 30-year period where it should have been, particularly in the small and mid-cap space. But it was also people going, well, hang on a minute, I'm an emerging market investor with a global fund. It's about relative value. And China had been slammed for so long. And the big way we've outperformed in equities over the last 4 years, to be honest, was massively overweight India 3 or 4 years ago and underweight China. And a lot of global investors have switched that trade. They've said China is so cheap. The monetary policy bazooka in China was fired in September. They are getting serious about the fiscal. Eventually you will get some level of growth coming back. If the state is underpinning property asset values by sucking them up from the private sector, you're hitting a floor. And once you do that, the chance of the natural demographic growth, which hasn't been great, comes back. China is just a whole hell of a lot cheaper, and India got so expensive in relative terms globally, not just against China. So there has been a lot of switching out of India into China, not a lot of which is not permanent capital.
Okay. Now, a lot of money that has come into India, at least in terms of fund flows, I'm saying in terms of fund collections, has come through India dedicated funds, not through the emerging market funds over post-COVID at least. Now, do you see any time in future? Now, of course, we are underway a fairly serious correction, at least if you just look at the post-COVID period. This is the first time we are seeing a more than 10-15% correction in the market. Do you see India becoming an asset class by itself? How far are we from that point?
Yeah, I do. I think that will definitely happen. All markets.
By when?
A week on Friday. I'll be here Thursday. I'll take the hat around, give me the money, we'll invest it, you'll do great. Which is a basic rule, of course.
No, on a serious note, like 3 years, 5 years, what would be your bet?
Well, I think it depends on your perspective. I mean, and a lot will depend on what happens geopolitically. And it's been very interesting seeing the evolution since 20 of how some of the larger institutional investors invest globally. It used to be when we went and spoke to the biggest investors, be they pension funds, be they sovereign wealth funds, they said, oh yeah, EM, I should buy that, here's some money. Or maybe I won't give you the money, I'll give it to some other idiot, but here's the money. They didn't really get into the nitty-gritty of what they were buying, and they just, we'll leave it to you to pick China over India, over Russia, over Brazil. And that was one of the biggest frustrations for my colleagues as we built local businesses, where our longer-term bet was two things would happen. The domestic markets would get much bigger, and that would drive the machine, but also global investors would start to say, I need to pick the winners. But while you had it's ironic that while you had all the benefits of globalization, you had a bit of a blurring at the edges of the foreign investor picking who to win. So yes, structurally investing in terms of manufacturing happens country by country, but the financial pool of capital tended to be, I just buy EM. So we spent 20 years trying to say to people, yeah, but there's a time you might want to buy Mexico and not Brazil, and a long time trying to persuade people to do that. The geopolitical stress of the last 3 or 4 years, ironically, has started some of the biggest investors thinking, wait a minute, I've got American pension funds are now asking us to pitch to manage money ex-China. We want EM ex-China. And as soon as they start thinking that way, that means that they start thinking, well, hang on, if I don't want China, maybe I do want something. And what we've seen over the last 18 months is we're having increasing conversations. We have an Indian team who are very good at what they do, and they're being asked to go and speak to the Americans, the Europeans, and those in Asia, talk about India-only money. And when people start thinking about India-only fund investing and India-only separate account investing, that immediately tells you you're getting to the point where you're a market of your own. Is it a black and white switch on, switch off? No. But is it happening over the next 5 to 10 years? Yeah, I think any serious global investor will have to have money in India, more or less, from 5 years' time, maybe from today. I mean, we do.
Right. Now, Indian markets have been actually the worst performer this year. Amongst emerging markets, I think it's the third worst. There was only, I think, Indonesia and Taiwan, which have lost about 11%. We've lost about 8%. Now, in one way, it is good because valuations become cheaper. A lot of the foreign investors who are probably waiting on the sidelines might want to get in. But how do you think realistically foreign investors look at this when you see this level of volatility?
How do I think they look at value here?
Yeah.
I think.
How do you view the volatility in India at this point in time?
Yeah, I think if I look at my fund managers who manage global books, it's quite interesting. You see a lot of investor psychology through the people you work with. I think they've all been looking for a moment to buy the market. I think they felt it's expensive, and they thought it was very expensive, and then they thought China was cheap, and so they reduced their massive overweight to India, and they started to buy China. At the same time, the institutions I mentioned before that are starting to look at single countries and trying to pick winners that have already started to pick India are saying, yes, it's all too expensive, but yes, I'm in here. And if my allocation is this, it goes up and down around the margin, but structurally I'm committed, even in liquid product, they're all looking at a chance to buy. I think they're saying, well, we're getting questions from the US through Europe, through Asia, is it time to buy India now?
Right. I asked this question to Howard Marks also, and I'm going to ask this question again to you. What is your sense of, what are the chances that the US economy will actually slip into recession this year? Because government job cuts, potential inflation coming back, all of these look like not very happy things.
I think there's there's definitely a reasonable chance. Recession, obviously, depending on, let's say you define it as 2 negative quarters of growth, which is a traditional definition. That would be a lot. I think it's going to depend. This is what I talked about earlier about policy. If you have too much policy uncertainty, the first thing investors do is get out or do nothing or sit in cash. And there are a lot of investors in the US already sitting in cash, and there are a lot of foreign investors who say, I've got way too much US dollar. What on earth do I buy? Where do I go from here? And the longer policy uncertainty continues and people aren't sure of the direction, I think the chances are that the consumer in the US listens, hears, and feels that. And then, whether they're losing their job or not, they find the guy down the road lost their job, and they just do less. So the things to really look for are activity levels in terms of consumer construction and all that kind of stuff. You know, employment is really a lagging indicator for all of that. It's really what do you see in terms of the front end, in terms of what purchasing managers are thinking. All that kind of inflation, again, is a lag. It'll follow all of that. So I think there is a chance that there's already, the conversations we're having in the US at the minute, there's definitely, if you're talking to people in the Midwest, it's, well, I'm just going to wait and see what I do for now. And yeah, I had cash, and I was going to buy long bonds now because I thought duration rates were going to keep coming down. Maybe I'll just wait for the minute. So I think what you're getting is a little bit of a pause into, you had the election, this is a pro-business president, everything's going to be fabulous, markets went crazy, everybody bought AI, isn't that fabulous, the world's over changing, and now people go, oh, wait a second. And at the same time, you've got the suspicion that, like every other technology advance, the second level advance is to reduce the cost of it dramatically. So as the first producer, you make a lot of money initially, but then you have massive competition. Doesn't stop the adoption, it still becomes a widespread thing, but it gets steadily less profitable for the manufacturer. So where do I see that in terms of the US? Do I see recession? Probably not. But I think what we will probably not get is a lot more rate cuts, despite the fact there'll be massive political pressure. Because if you're the central bank, if you're the Fed, you should be taking a longer term view. And although the president might try and lean on you, this Fed president, he's got 18 months to go. He's going to try and do the right thing. So I think you're probably it's going to be a little bit wait and see. You might get one other cut. But then the real question is, do you get rate increases? And it's totally going to depend on inflation. But what I do think is the Fed will take a wait and see between 2 and 3% inflation. If inflation doesn't pop through 3% and get going, I think they're going to do nothing. And if it doesn't pop through 3%, I think they'll resist some kind of recession. And also, we just don't know how inflation these tariffs are going to be. There are tariffs that are not that inflationary. There are tariffs that will impact some countries, not others. Services tariffs are not there at the minute, which is a good thing for India. Services are a big deal for India, and tariffs are not there, which means the relative cost still stays pretty cheap. Also, India's producing some things that are pretty hard to tariff equal to start producing them in America. So there'll be winners and losers of the tariff stories. So I think recession is possible. I think it's not likely in the next 3 months. I think interest rates will sit in quite a narrow band.
Okay. What is your sense on fund flows into emerging markets? Do you see a huge reversal this year, or is that wishful thinking?
Well, what we saw from 22 was American capital panicking and hiding behind the sofa, so exiting pretty rapidly. So we saw a lot of negative flow, through 23, 24. That's slowed down quite dramatically. We're now seeing, as I say, people starting to say, is it time for me to buy emerging market equity and fixed income? Let me think about value. What's supported that a little bit, which I think has slowed the flow down, is people just are so long the US. I mean, if they had a US equity position, shut their eyes, it went up 20% for a while. What's also supporting it a bit, I think, is they're seeing absolute performances pretty good within EM equity and EM fixed income. I mean, EM fixed income was the best performing bond market the last 3 and 5 years, despite outflow. So I think we're seeing investors sort of take stock. If I look at our client base, our best clients have been with us a really long time, and they have a strategic allocation, and they bring it up and they bring it down. So they're nervous, they brought it all down tactically through 23, 24. So they're still in the game, but they're much smaller, and they're open to be reallocating to us. That's true in equity and in bonds. And if anything, the US is very much an equity market, so they prefer equities. So the first thing that will be a flavor of the turn from the US will be people buying equities. We're seeing a tiny, tiny bit of interest in the mutual fund space, particularly in things that are seen as friends, looking for single country product or for product where it's friend shoring type story, not something that's seen as a competitor to the US.
Will it be necessary for Fed rates to come down for, a reverse flows to start to happen?
No, I don't think so. I think the key thing is
It's just
positive
that it's
spread.
perception.
I think it's a perception. I think what, again, like most things in life, when people feel there's some kind of floor or some kind of range that's established, then people start looking for the next place to go.
Incrementally.
Yeah, I mean, when everything's in one direction, people just tend to jump on the bus. But once things have settled down, people start looking backwards at numbers and start trying to look forwards. So I think we're in a position where we get a little bit of stability in terms of US policy, and people say, figure out, is geopolitics going to literally blow me up? If it isn't, then I can start investing properly. And as I say, in terms of flow, we saw big outflow in 23, less so in 24, less so now.
Sure. One last question. What's your take on the dollar and gold? Gold for a large part was seen as a hedge for the dollar, but both of them have been pretty much moving in tandem.
What was the first thing? Gold and?
Dollar and gold.
Oh, the dollar and gold. Yeah. Well, gold is obviously a particular asset class that people here are very expert in. I'm not. So I think I don't really have a strong view in terms of dollar and gold, to be honest with you. I think the dollar is expensive. I think the dollar needs to weaken. I think rate cuts are unlikely to be the driver for weakness from here. I don't think we're going to see massive rate rises, but just in terms of absolute flows, I mean, the US is now a massive, massive debtor to the rest of the world. I talk to our clients in Asia and Europe, and they say, we can't buy any more dollar assets, we can't buy equities. So I think that's quite interesting. It's an EM positive story, but I think it's also, ironically, I think we're going to have a euro positive story. The euro is going to have to use interest rates to support issuing a lot more debt to rearm. So I think actually, ironically, euro, which has been a bit, oh dear, what's happening with growth, I think the currency might see some support over the next year or so. I think EM will be part of the beneficiary of that. A lot of EM countries in that euro ambit.
Okay. Mark, just one last question. What is Ashmore's, how large are you in India? How bullish are you in India? And how do you look at India right now as a tactical market, or is this, do you exit at all? How is that portion managed?
Well, India is one of the economies that we've decided we want to be a long-term investor in. What does that mean? Ashmore invests in bonds, equities, and private capital. We do private debt, private equity. We're trying to be in any asset class where we think we can be good, and in a place where we can be good at it. That depends on people, and depends on the demographic being good for the economy. We want the bigger economies generally, and rule of law. So all those things, India ticks the box for us. We've been investing here for donkey's years, longer than we care to remember. It's one of the economies that we decided we wanted a local business. So we didn't just want to bring in global capital, which can flip from India to China and vice versa. We said to ourselves, wait a minute, India is an economy which, given the growth dynamic, we ought to be able to build a domestic business where we're appealing to domestic institutions and domestic retail investors to say, hey, we can manage your Indian money for you better than you can. And we believe we found a group of financial professionals. I think we've got a great team here that can basically do a better job than the market and do it consistently over time. So for us, India is a place where not only do we like to invest bonds, equities, and alternatives from offshore, we also want to do that from onshore. So we're building a domestic business, we're building a domestic asset management business, and I see India as one of the 5 or 6 economies where Ashmore will have a big Ashmore domestic business, unrelated to the global business, loving it, kissing it, feeding off it, sharing flows with it. But I think it's a place where we're going to build a big domestic asset management business. That's one of our targets.
Sure. That's all we have time for, Mark. It was absolutely incredible talking to you. Thank you so much.
Great. Thanks for your time. Thanks for listening to me. Thank you, everybody.
All right. Thank you, Mark. Thank you, Mahalakshmi. Now, while discussing India's road to a $10 trillion market, the foundation of its journey lies in how businesses are scaling and growing. Let's hear now from a finance expert on how financial planning, credit solutions, and microfinance can further be enhanced using AI and digital transformation and its role in India's growth landscape. Please join me in welcoming on stage V. Vaidyanathan, MD and CEO of IDFC First Bank, to take the stage.
Good morning, ladies and gentlemen. It really is a pleasure for us at IDFC First Bank to be at this very fantastic gathering, and we heard some wonderful speakers thus far. And Mahalakshmi and everybody who triggered such a wonderful debate, thank you very much for bringing those perspectives to all of us. Today, the key thing that I wanted to actually share with you is basically some key numbers about how the Indian credit market is growing, AIF, PMS, wealth management, and how all those numbers are coming together to position India, let me say, for the next 10 years. If you think currently there is some talk in the country at this point of time, is consumption demand slowing, is two-wheeler sales slowing, is FMCG sales slowing down, is rural consumption coming down, rural people are still saying good things, but urban consumption people are saying, is there a little concern there? And people say, is private capex slowing down? So these are some concerns people have. But, you know, it will really be useful to know that in the last 10 years, while these may be issues at this point of time, partially, but there are also so many things going India's way, which we should put it in context. Now, when you see India's growth over the last, evolution over the last 10 years, there has been just so many significant events that have happened. In the early stage of 2010 to 2014, there was rising interest rates, and the inflation was rising, GDP growth was slowing down. Then 2016, there was demonetization, which is a really big event because it sucked out 85% of the current country's cash, and you were looking to replace it with a new currency. Then you actually saw that there was a period of a twin balance sheet crisis, when the Indian lenders were short of capital and Indian large corporates were debted, and therefore both sides there was an issue. Then there was the 2018 ILFS crisis. Then there was COVID that came in 2020, going on up to 2022. Right now, we're talking of the Trump tariff. So the last 10 years, literally year after year after year, there's been something in the country that's been going on. But let me just share with you how the numbers have played out during the last 10 years, despite these crises that have been coming along. So this is how the Indian, credit market during the last 10 years has grown. It has now grown from, say, 125 lakh crores to 324 lakh crores. So this is the GDP. The India's GDP has come along. That's like touching about $3.8 trillion. And then you see the Indian credit market has moved from 64 lakh crores going up to 183 lakh crores. That's like about $2 trillion for easy conversion. And that's a 2.8x in all the crises we talked about. Then let me share with you how the agricultural credit in the country has been growing in the same window, has been growing from about 8 lakh crores to about 23 lakh crores. That's 3x growth in the last 10 years. You can see how the deposits have been growing in the country. Deposits have grown 2.6x in the last 10 years, from 85 lakh crores to 228 lakh crores. That's like about $2.5 trillion. Then you see how the savings balance has been growing, like 28 lakh crores, going by 2.4x to 67 lakh crores. You've got the term deposits, that's grown from 49 lakh crores to 140 lakh crores. So you can see, and 140 lakh crores, I'd imagine will be like close to about, maybe about, let me say about maybe 1.7 or 1.8 trillion dollars. And then you've got the equities market has moved to about 384 lakh crores, which is the market cap. The mutual funds in the country has grown 6x, from 11 lakh crores to about 67 lakh crores. You've got to see how the AIFs in the country has moved from about maybe less than 1 lakh crores, 70,000 crores, to about 12.4 lakh crores. That's a big growth. Let me call that about maybe $150 billion or so. And then you've got the PMS market has grown about 5.5x. Of course, it started from a early stage fledgling situation to about 11 lakh crores. That's about about $140 billion. You've got the Provident Fund market has grown from 6 lakh crores to 27 lakh crores. That's grown 4.5x. So these are the areas when you see this in the light of the context of the fact that India has had all these issues, global, domestic, inflation, COVID, etc. In the light of all this, broadly give or take, things have been multiplying by about 2.5x to 3x in the last 10 years. You can see from the numbers. And in the markets like your AIF, PMS, etc., it's also growth markets. You can see the numbers for growth about 6-7 times, mutual funds 6 times. So these are the really big numbers. So when you look ahead and you hear some of the news flow, you should be aware that regulator is watching, government is watching. They will push some fiscal button, they will push some, monetary button, they will do some, reforms. And India is capable of pulling off really amazing reforms. We saw it in the case of how GST was implemented in the country, and ease of doing business is going on. Income tax norms are being refined. So India is moving on, maybe ease of doing business and many other reforms. And, even if you see some temporary slowdown, people will push the levers and, pull up the numbers. Now, when we look at this sort of a growth in the country across all asset classes, we need to now next think about who is availing of this big growth of this Indian market. Now, if you think of wealth management as a proposition, you can see that wealth management as a proposition is normally afforded to people having balances of, let me say, maybe 20 lakh, 30 lakh, 50 lakh, and so on and so forth, because these are largely supported by humans. What is the issue with this growth? I talked about how things have grown between 2.5 to 3x in the last 10 years. Now, how do we expand this market for the normal people is going to be a very key issue to address in the times to come. Wealth management and multiplying the value of wealth, and because of all the reforms India is doing, is of course great for people who have the wealth, but people who are, let me say, just off their radar and having maybe even earning, say, 1 or 2 lakhs per month, saving maybe 20,000, 30,000 a month, even for them, that is wealth in their life. In fact, for them to create that wealth and to multiply that amount of 20, 30, 50,000 or so is super important. For the rich, wealth is exciting. But for the not so rich, because let me call the middle class, for them growth of wealth is an absolute imperative. Now, we can't afford it through relationship managers. We all know that because relationship managers are expensive. So there comes the whole concept of how India's digitization and digital ecosystem is going to enable this wealth creation, let me say, at the middle class, lower middle class, upper middle class, in this sort of ecosystem. So at IDFC First Bank, frankly, we are looking at this all the time. When we are talking of lending, of course, all the big banks, everybody gives home loans at maybe 8.5, 8.6%. But what about the Kirana store? And what about the farmer who wants to buy a home? So figuring out how to take mortgages to them. Similarly, how to take deposits to them. Now, in today's context, how to take wealth management to them. We also agree cannot be done by human beings. So I want to show you a quick demo to you about how we brought this together, or how we are bringing this together for the common people, so to say. Now, this is a mutual funds. Now, I talked to you that India's mutual fund industry grew from, say, about 12 lakh crores to 70 lakh crores in the last 10 years. If all goes well and reforms goes well, and, reforms and India's entrepreneurship and growth, all of these create wealth. Digitization of the new digital ecosystem in India can take wealth to the can make wealth management more accessible to the 300, 500 million people of the country for whom it is equally important, like I said before. So I want to share with you that how do you make this enabled? So I want to just, if you say, we are trying to make something called wealth management for all. So one of the things here is, say, invest in mutual funds. Now, invest in mutual funds, we are putting together a platform for public at large to say how you can do your own research. You do not have to follow IDFC First Bank's research about you buy this mutual fund or that. We provide you a platform. Say, for example, we say, okay, you can invest in equity. Within equity, supposing this is the fund that we're being talked about, in this fund, you're able to see what is the 1-year return on this fund, what is the 3-year return on this fund, what is the 5-year return on the fund. This platform is available for you to do your own research. You can live see what is the 3-year performance, 5-year performance of this fund. You come down from there and say, okay, what are the companies this particular fund, may have invested in, and you can. What are the companies being? Holding pattern. So you can see the companies that are there inside this fund and what the fund is holding live. You can see the companies held by that particular fund. And then you say, okay, I want to invest in this mutual fund. You can say, I want to select this for one time. And then you can say that I want to say invest ₹1 lakh. And then you say, I want to here to invest. And then you say, this is the OTP. And then you verify. And as we speak, this investment is done. Now think, to make the funds available on platform, you can sort them, select the best, or you can accept a research that is maybe done by IDFC First Bank in this example, and make an online investing. This is super important for the common people. And one of the agenda of this should also be how to make wealth management accessible for all, because it's important for everybody. Now let me give you an example of, again, people at this pyramid who typically would like to have, let me say, retirement planning. One of the issues that we find in India is that most normal people, certainly middle class, upper middle class, they live their life by the day, and suddenly they are in their 50s or 60s or 50s, and they figure out, oh, there's not much money left in the kitty, so there's need for financial planning. So we put together something for our customers here, where we say that you can do financial planning, and you can do goal-based investing, and then you can come here, you can say you want to plan your retirement. In the retirement, supposing someone says, I want to say have 5 crore rupees at retirement in say 2050, our system will instantly tell you through a tool that you really need 28 crores then, assuming inflation of 7% during this period, to actually have the value of 5 crores today, which is not a calculation customers normally have. And then we say, okay, what do you do with this money? So you say, get me investment options. In that, again, it's a choice customers are making. And then you say, okay, I confirm this plan. And then on 10th of every month, the bank will debit a bank account and move it in the fund chosen by you. Here is an OTP. Here you verify. And then your plan for that amount starts. Similarly, you can plan for retirement, home, car, etc. So the point is that and if you want to say invest in a fixed deposit or so on and so forth, the point just to sum it up is that that if you saw the numbers of the last 10 years, I showed you everything is up 2.5 to 3x, whether it is gold or whether it is deposits or credit or any of them. In the next 10 years, with the amount of reforms India is doing, with the amount of investment infrastructure India is doing, with the amount of ease of business, doing business focus, with the focus on digitization, with the creation of this entire ecosystem, one thing is certain, that the Indian ecosystem is set for creating more wealth in the next 10 years, maybe by an order of magnitude between, let me call it 2.5 to 3x, if you were to go by the nominal GDP and you were to multiply it and compound it by maybe 11 or 12% for 10 years. Through these, we will be in a position to take this to let me say, middle class or even bottom of the pyramid, for whom even 10, 20,000 rupees is wealth. And we should realize that what is wealth for us, maybe 20, 30, 50 lakhs, is for the common people, even 10,000 rupees is wealth for that person. And our ability to take it there is going to really define the more inclusive wealth creation and using digitization to make wealth management accessible for all. So this is all I have to share with all of you. Thank you, ladies and gentlemen. And hopefully these numbers are going to help us in the course of the discussion. Thank you.
Well, thank you for that, Mr. Vaidyanathan. Let's move on now And for the next session and for our next guest, let me invite back on stage Nalin Mehta from Moneycontrol.
Thanks very much, Sonal. Ladies and gentlemen, it is my great honor and pleasure to welcome to the Moneycontrol Global Wealth Summit the Chairman of the Securities and Exchange Board of India, Mr. Tuhin Kanta Pandey. It's just been a week since Mr. Pandey has taken office as the 11th Chairman of SEBI. And we are deeply honored, sir, that the Moneycontrol Global Wealth Summit is the first major event that you are gracing since taking charge of the markets regulator. Mr. Pandey has a distinguished record as a public servant, most recently as Union Finance Secretary in the central government. He's a 1987 batch IS officer from the Odisha cadre. Mr. Pandey has also served as the Secretary in the Department of Disinvestment and Public Asset Management in the Ministry of Finance, as Union Civil Aviation Secretary, and he's also held key positions in the Odisha government. Mr. Pandey has a Master's in Economics from the Punjab University and an MBA from the University of Birmingham. Ladies and gentlemen, I'm sure you're all very keen to listen to Mr. Pandey, so without further ado, please join me in giving a big hand to the man who now heads India's capital markets regulator, Tuhin Kanta Pandey, the Chairman of SEBI, for his keynote speech on India's growth story.
Men, I am delighted to be here today amongst this august gathering to share my views in this Global Wealth Summit organized by Moneycontrol and CNBC. Our aspiration for a Viksit Bharat, a developed India, by the year 2047 inspires us to march forward resolutely, propelled by 3 Ds: democracy, demography, and demand. India has exhibited resilience as well as strong growth momentum over the years as we face global headwinds in terms of geo-economic fragmentation, tariff issues, and elevated uncertainties. We need to build upon our resilience and strength to sustain our growth. A high level of sustained growth, low current account deficit, low external public debt, healthy bank balance sheets, fiscal consolidation roadmap, continuing government push on government capex and infrastructure, and forex reserve buffer are some key pillars of support for India's resilience against exogenous shocks. As per IMF estimates, overall economic growth in emerging markets and developing economies is projected at 4.2% in 2025, while India is estimated to grow at 6.5% in FY 24-25, indicating a strong growth outlook for the country among the peers. Indeed, many a forecast envisage that India will have a sustained growth of 6.5% over at least till the end of the decade, although we would like to accelerate it much faster in order to achieve the Viksit Bharat goal. In her budget speech on 1st of February 2025, Honorable Finance Minister has outlined government's vision, strategy and action plan, focusing on 4 engines: agriculture, MSME, investment and exports. She also underlined major reforms in 6 domains: taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Let me just now come to the role of the security markets in economic growth. We are all aware, over the years, Indian securities market has played a crucial role in channelizing savings into the productive investments, thereby fueling economic growth. Indeed, raising the savings and investment ratio has been one of the very important goals in the economic planning that we have. It's always provided a platform for businesses to raise capital efficiently through equity and debt markets, reducing pressure on traditional banking channels. And it has facilitated corporate expansion promoted entrepreneurship, and contributed to overall economic development in the country. And let's see some data points. As of March 2020, there were 49 million unique investors in the SEBI ecosystem, which is now 136 million. Investors in mutual funds have risen 2.4 times in 5 years to 53 million from 22 million. Inflows into risk-oriented mutual funds during current year, which is April-March till January, are of the order of 5.3 trillion rupees. Over the last 10 years, Indian companies have raised on an average 2.2 trillion rupees per year through equity issuance in the securities market. The current fiscal year so far, April-Jan, has seen a record equity issuance of 4 trillion rupees, twice the capital raising of 2 trillion rupees witnessed in the entire previous year, FY 23-24. These are some of the key points. I think there are many. This access to funding through the capital market drives expansion, enhances productivity, fosters innovation, all of which contributed to economic growth. We need long-term capital through both equity and debt issuances as a source of stable funding, fostering sustainable economic growth. And new products like REITs, InvITs, and municipal bonds have huge potential to boost infrastructure development in the country. These products not only provide a diversified source of funding, but also reduce reliance on traditional sources of capital. Let me just come to some of the roles that SEBI is playing. Of course, in case of regulations, SEBI has provided the regulatory structure for REITs, InvITs, and municipal bonds. Some of the new innovations. Over the years, SEBI has taken measures to promote developments of securities market, which is actually as one of our mandates. Reduce risk in the system through effective regulation and protect the interest of the investors, and underline protecting the interest of the investors. Broadly, the reforms are aimed at enhancing efficiency, transparency, and robustness of the security markets, and we have used technology in a big way. Entire marketing infrastructure, securities market infrastructure, we have been bringing in technology and to facilitate things which we earlier couldn't even imagine. All reforms need not be big bang. Many a time small reforms cumulatively are more effective. Going forward, SEBI will use a right mix to both to achieve the objective. Indian capital market has witnessed a surge in individual and domestic institutional investor participation. Ease of investing through digital platforms have significantly boosted retail investor engagement. You saw one live demonstration by Mr. Vaidyanathan. I think there is enormous work which has been done by the industry in bringing in, these apps which can facilitate so easily making of investments. But then I think it also adds a lot of responsibility on us as well as the market players. Now, increasing participation by domestic institutional investors, including mutual funds and pension funds, has resulted in greater domestic ownership and made Indian markets more resilient. You may have noticed, there has been FPIs because FPIs may react to global events and come in and out. Nevertheless, I think domestic institutional investors have stably filled up the gap in many ways. Not to say that FPIs are not important, and I'll come to a little later of what we need to do with respect of FPI flows. To foster financial inclusion and provide access to security market products and services to wider sections of the society, we are committed to facilitate market innovations and development of new products and processes, low-value mutual fund SIP, small and medium REITs, which we call SM REITs, and specialized investment funds, SIFs, are testimony to the same. As we intend to grow in the speed that we are aspiring, we need to have both domestic and foreign capital to support the growth momentum. With strong economic fundamentals and favorable demographics, India is a bright spot for long-term investments. The country has attracted global investments across equities, debt, and private equity spaces over the years. The presence of such long-term foreign capital would further support infrastructure growth, innovation, and entrepreneurship in India. We at SEBI are conscious about the need to create conducive environment to attract foreign capital. We will be happy to engage with FPI and AIF industry participants to address their difficulties and further rationalize regulations to promote ease of operation. Trust and transparency are the pillars of a healthy capital market. For sustainable capital market growth, maintaining trust and transparency in the financial ecosystem is paramount. A well-regulated market instills confidence among investors, ensuring fair and efficient capital allocation. Regulatory bodies, market participants, and corporates must uphold the highest standards of governance, disclosures, and ethical practices. Enhanced transparency in regulatory action, corporate reporting, and market operations will further strengthen the trust of both domestic and global investors in India's financial markets. And I think the trust and transparency extends to SEBI itself. We need to not only create trust of all stakeholders in us, but we also need to maintain that trust. And to that extent, I think we need to be more transparent, including on various other measures, including, for example, on the conflict of interest of the board and so on. And we will be coming forward with our own plan to further transparently, reveal these conflict of interest, etc., to the public. Ease of doing business in capital market is applicable in all the three touch points: point of entry, point of transacting, and point of exit. Capital market is a dynamic space, so change is imminent, but we will certainly not be looking for maximum regulation, but for optimum regulation. If some statutes are redundant and outdated over the years and not serving any purpose, we are happy to review the same and change them. We are open to ideas on this. Laws and regulations are better enforced through voluntary compliance. I am looking forward to engage with all stakeholders to discuss what more measures need to be taken to encourage voluntary compliance. I mentioned when I joined 4 T's: trust and transparency, teamwork and technology. And when I say teamwork includes the teamwork within SEBI. It also includes teamwork with various participants, investor bodies, the market participants, the market infrastructure institutions. And together we can actually create a further conducive ecosystem. We have come this far. We have to think of next 25 years. We have to think of how 2047 will look like, how we can move together. We have to bring in technology. As I said, technology is always a changing thing. Use the technology to do things better, to more transparent, and give the integrity to the market institution of an order which we should be all proud. But for that, we need teamwork. We need, everyone to come together to do that. So teamwork is more than what is inside. It's also outside. SEBI plus others. Same is true with technology. The market is not a straight path. In order to ensure that investors are not lost in labyrinth, investor awareness and education is very crucial. An informed investor is self-protected. SEBI's effort in the days ahead is to create awareness among both existing and prospective investors. The question is, how do we create awareness? And that is where we need to explore different models of creating awareness across this big country. As said, we may have 400 million PAN-linked Aadhaar accounts. We're still there talking about 135 million of accounts who are trading. We have very slowly we will ramp up to that number, and accordingly we must also plan that how the people are also aware of the risks, how the people are able to do the wealth management in a manner which suits them, how they allocate their own capital portfolio, which also de-risk them when they have to, and take whatever necessary in terms of allocation between the debt and the equity in a manner which suits them. As Charles Dickens said in A Tale of Two Cities, it was the best of the times and it was the worst of the times. There will be difficulties, ups and downs, but India's economic and capital market growth is a strong trajectory backed by policy support, structural reforms, and rising investor participation. With a thriving securities market playing a pivotal role in economic acceleration, India is well positioned to remain a global investment hub and a key driver of the 21st century economy. Thank you for your attention. Jai Hind.
Thanks for that, Mr. Pandey. Now, amid rising geopolitical tensions and growing concerns over the strength of the dollar, gold is experiencing a dramatic resurgence. As India's second most owned asset class, gold has delivered a significant wealth effect for Indians. But how sustainable is this rise? Let's find out with Manisha Gupta from CNBC-TV18 and requesting David Tate, CEO, World Gold Council, to join us on stage, please.
Thank you, Sonal, for that. Well, all that glitters absolutely is gold. If you look at the last 6 months, we've seen gold prices make string of all-time highs. In this year, until now, we're up by 11%. Last year was 28% of gains. If you look at last 12 months, we're up by 35 to 40%, depending on what currency you're looking at. David, I do understand that World Gold Council does not give out price views, but are you as bullish as so many banks and brokerages, because they're putting out much higher levels for this year and the next as well?
I know you would expect me to say yes, given my role, but yes, and the reasons are frankly not very obvious to many people, but becoming more and more apparent. I think pretty much every indicator of where gold should go is pointing upwards at the moment, but probably the most important thing is the burgeoning debt throughout the world. I think the global long-term sovereign debt has reached, I think, around about $76 trillion now, and is going to be added to by a further $13 trillion. And whichever way you look at it, we seem to be approaching, shall we say, through tariffs and inflationary push, which is going to steepen yield curves, in my opinion, which is going to make the reality of financing that debt very, very relevant to people. And I think the one asset class that always steps into that gap at that time, rightfully so, is gold. And I can't see an alternative to going higher.
You know, David, for the longest time, a lot of people, financial advisors for that matter, kept saying that gold is an idle investment, doesn't give you dividends. Look at some of the equity stocks or indexes for that matter, and they have given strong returns. But then look at last 3 months, and if you did not have gold in your portfolio, then you perhaps weren't recently leveraging it. Near term, yes, we've seen the gold prices gain up, but with the kind of scenario that we are in right now, macros, geopolitical tensions, tariffs for that matter, do you see gold prices holding these kind of return on investment for a longer term?
Yes, I do. I think it's an important thing to have as part of a portfolio, and very few people, and we are trying to change that phenomenon, truly understand that. To have gold, as you heard a speaker earlier, Mark, mention, to have gold as part of a portfolio and raise it and lower it depending on your view of the world is critically important. If you do not have gold as part of a portfolio, you're very likely to fall foul of the geopolitical, geoeconomic problems that we're seeing at the moment. For instance, even if you were predisposed to hold Bitcoin as part of your portfolio, which I'm not, but if you were, it's even more important that you have gold as part of your portfolio going forward. In fact, even the central banking community views gold as part of their overall portfolio, as importantly as individual investors should.
David, you don't have to sell gold to Indians. I mean, we buy it when a baby is born, to marriages, to anniversaries, and then occasions and festivals, and then we found reasons with...
Your microphone.
So as I was saying, India doesn't need a reason to buy, but the whole financialization of it and the way it is now included in portfolios in sense of ETFs and digital gold and sovereign gold bonds were a huge success as well. Do you see that change coming, and do you see that staying?
Yes, I think the sovereign gold bond was very, very successful for investors, perhaps less so for the government, but nonetheless, I do think that as your generations become more financially literate, you've got a swathe of young people out there looking for a way of investing in the financial markets, not least gold. I think that the instrument that will take the place of sovereign gold bonds is going to be gold ETFs. A little known fact to many people, ironically, ironic to me I should say, is the fact that ETFs are gold backed, 100%. They're listed, they're regulated, they are a very safe way of investing in gold. And as you've seen from the previous 2 to 3 presentations, the amount of money that is in this country and growing exponentially that is available to invest is an enormous opportunity for the ETF market. I fully expect to see that skyrocket. I really do, as people perhaps shift, and I say perhaps, shift from the physical gold investments into a more digital gold investment.
And as we see more financialization of gold, are you looking at a more wider, diverse pool of investors coming in for this?
Absolutely. When I first joined the World Gold Council, the industry as a whole in India, and perhaps even the World Gold Council, was very focused on jewelry, rightfully so, and that is an enormous market. I don't need to tell you that. But what I think is an enormous opportunity, not just in India, but perhaps in China and also in Japan, 3 major pools of capital, is the growth of the ETF industry. And I think that can bring many institutions, many asset managers, many mutual funds, many pools of capital out there that have hitherto not looked at gold to the market. So when you combine the geopolitical, the geoeconomic, the simple maths that we have become so accustomed to with gold, you combine it with those 3 enormous pools of capital just coming online, you can see what the potential for gold could be as a financial asset.
The other thing about India really is that we have, hallmarking clearly given a lot of confidence where people were buying physical gold. But the other thing that the World Gold Council also is talking about, traceability of gold, that really takes it further notches higher.
Absolutely. This is, you've heard traceability on the previous speaker with transparency, trust, traceability, all these things. These are absolute cornerstone of what we're trying to do at the World Gold Council. We have, in conjunction with the LBMA, the London Bullion Markets Association, in 2022, set up a database for all responsibly sourced gold. It is a database because when I came into this market, I, for one, was somewhat surprised that I couldn't check the provenance of an investment bar and coin. Simple. So we've set this database up with the hope that it will grow exponentially. For instance, it has all newly produced gold going into it. For instance, all my large-scale miners. It has the LBMA has adopted it. All refiners will be going onto this. and we hope many other people in due course. And the hope of this database is at some point, perhaps not too distant future, it will become unthinkable for anybody to buy an investment bar and coin without having first checked that the gold's veracity, provenance, integrity before buying it. My hope then is that the gold that sits outside the database, perhaps being used for nefarious practice, tax avoidance, etc., shrinks over time. It won't be an overnight phenomenon, but we are incredibly focused on that.
David, I want to come yet again on prices, really, and we've seen, when you look at other asset classes, and if you look at last 5 years and 10 years and 15 years, and people go around saying, when I was married, gold was there, and this is where it is right now. The way gold has performed, and sometimes outperformed various other asset classes, and the way we are right now at all-time highs, are we at uncharted territories? Where are we going, and where will gold take cues from?
I think, are we uncharted? Almost. We're on the brink of 3,000. Do I see it going higher? Personally, absolutely. Where the main push is going to come? I think there's an enormous older generation in Japan. And to my surprise, they keep roughly 60% of their money quite literally under the bed. That generation are passing on their wealth to a much younger generation who are very financially literate and have the iPhones, and the penetration of the iPhone has made an enormous difference to them. I think in China, you may have recently heard that the insurance industry, only in the last few weeks, has opened up their insurance industry to the possibility to invest in gold. Just 1% now, but it's a $4.8 trillion market. If they invested just 5%, they're more likely to invest 10 to 15% in gold. Any one of you can do the mathematics. And of course, in India here, you have an enormous younger generation, as I've already mentioned. But the added push is going to come from two things. One, continued central bank buying, predominantly central banks who are, shall we say, developing central banks, who still have a relatively low exposure to gold. And the reasons why they would think that are, I think, obvious to everybody here. You can see world events, you can see economic uncertainty, and they manage their reserves very much like you do yourself. And so I think they will continue to accumulate. And the last thing is, and I must mention it, is the fact that over the course of the last 5 years, we have been working furiously with a huge group of banks and regulators in London to move and to digitalize the London, in fact, the global OTC markets. This is moving the market very much from a 1985 copper wire feel to very much a 2025 feel. And I think that will open the market to an enormous number of financial investors. And you noticed that Mark had never traded gold. No surprise. It will open that market to an enormous number of asset managers who have hitherto haven't even thought of trading gold.
David, I also want your reaction to a recent happening where US brought in a lot of physical gold and silver. Even when we look at COMEX right now, the net long positions are near record highs. Silver net long positions on COMEX are at an all-time high. So the kind of buying that, or rather the holding that gold is doing right now, and this is perhaps because of tariffs, ahead of tariffs, how do you look at this phenomena? Until now, we were looking at London for gold prices. Are we looking at huge premiums and discounts, and are we looking at prices changing in sense of reference on what the world has been looking at?
Yeah, I for one, come from a fixed income and FX background, principally. And when I came into this market, I was bemused, to say the very least, at this simple phenomenon that everybody's got a different shape and size of gold, and in order to settle contracts at the CME, London has to fly them across the Atlantic in planes, and I didn't know what was going on. I had to try and unpick why people didn't invest in the gold market, and that was just one of 1,000 things we tried to solve. I think, firstly, that phenomenon of different shapes and sizes is going to be solved by the digitalization of the asset class that I mentioned. Going back to the reason why we've recently had this, some say, hoarding of gold in the United States and silver, as a precursor to perhaps having tariffs imposed, My view on this was that we as a group, the WGC, could not really fathom a reason why gold would be picked out in isolation. It might get caught up in other things. For instance, I've noticed it's included slightly in cross-border Mexico-US tariffs, but it's more a scoop effect, not specific. And I didn't see the tariff effect on the London-New York market lasting for very, very long. And I've luckily been proved right. If, for some obscure reason, Mr. Trump decides that gold is now the enemy, or he decides to try and make everybody mine only in the United States, which is inconceivable, then we'll deal with it again. But the simple fact that we are faced with those cross-border challenges because of the different shapes and sizes and grades of gold are the market's own problem. And that is what digitalizing everything is going to change in the long run.
And, David, this is a question that everybody's been talking about. Is there all that gold in Fort Knox as is talked about?
I would absolutely say 100% yes. I think it's absurd to suggest it's not. Interestingly enough, even though the World Gold Council owns GLD and GLDM, the two largest gold ETFs, we still have people questioning me, saying, you don't really have the gold, do you? I assure you, I've seen it. I've touched it with my own hands. Every single gram of it is there. And it is quite an impressive sight.
That is good assurance. David, a lot of people talk about de-dollarization, cryptos, and gold in the same breath. How do you look at that analysis or that correlation that investors try to make?
It does amuse me a little that we spend a lot of time trying to, I wouldn't say convince, explain people why having gold as part of a portfolio is an important part of a portfolio. And rather than it being an opinion, it's really mathematically proved. We have the econometrics to prove it. You can find it. You just need to interrogate the World Gold Council and you'll find the data you need to convince yourself. It is somewhat amazing to me that people will commit their personal wealth to a string of digital code with no explanation whatsoever. And I sometimes wonder whether we try too hard to try and explain the value of gold to people. That being said, it's easy to say it's here forever, but it's also, we all know deep down inside, it's possible for it to go to zero. So I'm not going to be one of these people that say that it's bound to collapse. It might perpetuate, but I do look upon it as a speculative tool only. I would not be a store of value for me. It would be, it's going to move fast, therefore I want to be in, I want to get out, I'll invest what I can afford to lose. Gold, on the other hand, is something that you hold for a lifetime. It should always form part of a portfolio. And if you don't, you are putting your portfolio and its returns at risk.
My last question then, David, and what would you advise investors on what part of their portfolio or percentage of their portfolio should be gold?
I would say between 10 and 15%. The World Gold Council's view, official view, is 7 to 8%, but I would say 10 to 15%. I think that suits the current economic environment. I'm a relatively conservative investor. I always have been. My career is 35 years of trading and investment banking. But nonetheless, I was not one of the people who blew the doors off with trades. I was more a consistent trader over many, many years. And in that context, I see it as almost an act of self-harm to not have gold as part of a portfolio in whatever form you see fit.
Thank you so much, David Tate, for joining us here. Really appreciate your time. Thank you, gentlemen, so much.
India stands at the cusp of an unprecedented leap today. A $10 trillion stock market, but achieving this milestone requires more than just momentum. It demands sustained 9% GDP growth and strong valuations. Can public investment boost growth while maintaining fiscal discipline? Will job creation ignite domestic consumption? How can exports expand amid protectionist trends? Do Indian corporates have the capacity to raise, absorb and deploy capital efficiently? The stakes are high and the opportunities are immense. To lead this critical discussion, I'd like to invite on stage Bodhisattva Ganguly Group Consulting Editor, Network 18. And to dive into this very interesting discussion, may I please also welcome on stage Anish Shah, Group CEO and MD Mahindra Group, and Neelkant Mishra, UIDEI Chief and Member PM, Economic Advisory Council, Chief Economist Axis Bank, and the Head of Global Research Axis Capital.
Thank you, Sonal. Thank you, Anish. Thank you, Neelkant, for making it here. I must say, when we conceptualized this program about 2 months back, 3 months back, we had not anticipated the extent of the fall in the market. So please treat the 10 trillion market cap figure as aspirational. This is both for the panelists and as well as for the audience. I'm sure we'll get there, but maybe not in a hurry. Let me, with those words of caution, as it were, let me first start off with Anish. Under his leadership, the M&M group and M&M as a company has achieved tremendous. Their market cap has grown dramatically over the last 4.5 years, maybe in a fall in recent times. But given the extent of gains in market cap, given how the share price is done, particularly of the flagship, it's going to get harder from now on, isn't it?
Bodhi, in many ways, I'd say if the foundation is strong, then future growth becomes easier. And we've had a very strong foundation. In fact, I often remind folks that M&M was the best performing stock in the Nifty from 2002 to 2018. And after that, we've grown significantly since then as well. So I think we should, in some ways, we feel very confident about the DNA of our group, the ability for us to be able to deliver growth. And as we've always said, our results will speak for themselves.
But what are the strategic initiatives that you have in mind in terms of driving growth, which eventually, hopefully, will show up in a higher stock price over the medium term?
I think that's a fundamental question, Bodhi, and we start with the fact that we want each of our businesses to operate at a very high level. We use the term operational excellence internally a lot. What that means is that we are delivering the best products to our customers. We are delivering that in a manner that creates the best customer experience, in a manner that has the highest level of productivity. And that enables us to grow market share, that enables us to have better margins and create leadership in multiple industries that we are in. And that is what has driven our growth. And each business has a set of strategic initiatives, which I won't go into right now, just in the interest of time.
Right. Neelkant, if I can bring you in. The economic survey, I think it was not this one, the 2024 economic survey, expressed some concern over financialization of the economy. You also have some views about what is a healthy market cap to GDP ratio. Why don't you talk us as to, are we now at a healthy level given the fall? What is a healthy market cap to GDP ratio?
I don't think there is a healthy market cap to GDP ratio that you can prescribe at all times. Markets are going to be trading in ranges. As you think about the market cap to GDP ratio, divided into two parts. What is the corporate profit to GDP ratio, and then what multiple you want to apply to that. For a long time, I would say from between 2010-12 to 2021-22, the profit share of GDP was falling. So, and therefore, Nifty earnings were growing at 4%, actually till 2019, and then GDP was growing, of course, at 11-12%. So, I don't think in the next 5-6 years, profits will grow slower than nominal GDP. So that should be supportive of a higher market cap to GDP. This is one of the reasons why even in the US, the market cap to GDP ratio is very high. In China, it's very low because corporate profitability or the corporate profit share of GDP is low. Then it comes to the multiples. Now, the multiples by definition will be volatile. So you will see them getting affected by cost of capital, what is the risk-free rate, what are the alternatives available, and general euphoria and pessimism. And I think we are coming off of a very high level. We were at a record high. We've never seen those levels. The range that, if you plot 2004 to maybe 2020 or so, was 60 to 80%. We were at 120. So we are now maybe down to about 100%. Can it fall another 10% from here? Perhaps yes. Will that happen because nominal GDP grows and market cap stays the same? I think that's the most likely scenario.
I just wanted to take up one of the themes, and that also leads us into questions on consumption. But again, the last economic survey, and I think the one before that also, has criticized the corporate sector because what it's saying is that the rate of growth in profit, I'll ask Anish to weigh in on this, but first you go. The rate in their profitability has grown quite fast, but they're not paying enough by way of wages. The wage growth is slow. What are your thoughts on that? And is that leading to a weakness in consumption?
I think the observation is right. I'm not sure this can be solved by corporate suddenly becoming more charitable. There has to be a market solution to this. So remember that at this stage of economic growth, most economies tend to see a rise in inequality. So there is a surplus of labor. This is a classic Arthur Lewis growth model, where there is a surplus of or underemployed people in agriculture who want to get employed. By solving some basic problems, we have significantly increased the number of women who want to participate in the labor market. But the number of jobs that we can provide can only grow at 1 or 2%. And therefore, labor doesn't have enough pricing power. Capital is in shortage. That is pretty much the constraint to GDP growth right now. And therefore, capital formation, so the capital share of income keeps going up. And there is another aspect to it, which is that the investment share of GDP, which was at 34% in 2012, had fallen to 27% in 2021. It has since then bounced about 3-4% points. But as the real estate cycle turns, as the power generation cycle turns, I expect it to keep going up. So if GDP grows at 7, consumption will only grow at 4.5. This is arithmetic because most of the activity is happening on the investment side. And within that, the top 15%, 20% may grow at 8-10%, but the bottom 70-80% may grow at 3%. Now that is the outcome you should expect if there is no intervention. How is it that we were able to bring down consumption inequality between 2012 and 22? It was by significantly investing in productivity boosting things like providing people electricity, providing people cooking gas, toilets, pakka houses. And maybe now we need to take it one step further and provide them cheaper capital. And so there are tools to reduce this, the pace at which inequality worsens. But I think we should gear ourselves up and maybe expect some further increase in inequality.
Anish, your views? Are companies being too stingy in giving out wage increases to their employees?
In a capitalist society, I think each company would do what it feels makes sense overall. From our perspective, we have been more than fair with everyone. In fact, we've seen a significant amount of growth as well. And most importantly for us, we are very clear that our biggest asset is our people. And therefore, that's one that we always put first. And while the averages may suggest something different, I think I would just say that in a capitalist society, sometimes you've got to go through some of the cycles and things work out better after that.
There's been a lot of debate recently about the work week, about 90-hour work weeks or 80-hour work weeks. What are your views on that?
So I've had a very clear view on this, which is each person must set the right balance for themselves. Over my career, the balance I've set is weekends will always be with family. And that's one thing I look back and I'm very happy about because the years I've spent with my sons growing up is something I wouldn't have wanted to give up. And during the weekdays, I'd work what was required. I've never counted the hours, but I would always spend weekends with family. But that's my balance. Right? I think each person should set their own balance and should do what is right for them at that point in time. So there should not be a definition around number of hours. It's more about the output, the quality of the output. It's about the balance that each person wants. And organizations must support that. And that's what we need a friendly culture, a friendly organization to do, is to be able to say that we recognize the balance each person wants. There are times when there are needs of individuals that require even further balance. And that's what an organization should be able to support at a time of need for each of their associates. That's one thing at the Mahindra Group we are driving in a significant way in an overall initiative that has been there as part of our culture for years, which is around We Care. A specific maternity program that we have is a 5-year maternity program in terms of significant, not just benefits, but in terms of how we provide the time that each person needs when they go through maternity. And not just that, but across many different things. So for me, it's more around, can an organization support the needs of each person, and can each person ensure that they have the right balance that is appropriate for them?
So the question is for both of you. So, obviously economic growth since COVID has largely been driven by government capex. And I think in the communication after the budget, the finance minister and including the former finance secretary, now the SEBI chief, they've all said that the government capex obviously can't keep growing at 20% plus indefinitely. So the private sector needs to step up. When will that happen? Anish, why don't you go first, and then I'll come to Neelkant.
Well, Bodhi, first I would give a lot of credit to the government for staying consistent on capex, because the multiplier effect is far greater. Having various SOPs can increase demand in the short run, but that's not the right approach for the economy, so I would give a lot of credit there. From a private sector standpoint, again, back in a capitalist society, it is going to depend on capacity utilization. Our auto business has almost quadrupled capacity now in the last 4 years, because we've seen that level of demand. The industry overall has not grown at that rate. Many other industries are starting to get to 75-80% capacity utilization. That's when we're going to see greater capacity come in. So I feel that private sector capex will follow. Overall, we are very optimistic on the Indian economy. And it is just a matter of time that will happen, but that is part of driving greater demand, and which will then result in higher capacity utilization and therefore private sector capex.
Neelkant?
Yeah, so I think we have to view the problem a bit differently. We are getting caught into that classic psychological trap that something that you see very often you think is very important. Just to give you perspective, if India's investment to GDP ratio is 32%, central government capex as a percentage of GDP is 3.2%. So it's only 1/10 of the total capex that we are doing currently. So to ascribe all of investment in India to just what the government is going to do in the next 3 months is, I think, being very myopic. So I would break this down into 2 parts. The first is, why did the investment to GDP ratio fall in the first place? So of the 7% fall from 34 to 27 between 2012 and 21, 5% point was because of a drop in household investments in dwellings. It was the real estate cycle. Just because it is not something that can be managed at a central level does not mean that it's not important. The real estate cycle is an absolutely integral part of business cycles in most large economies, and so it is here. The recovery that we have seen post-COVID has actually been boosted by a significant pickup in real estate capex. The second part is the corporate investments in power generation and on items or goods that feed into real estate construction are the 2 elements that slowed down the most, because the real estate cycle was down, the power generation, we had overcapacity. Now we need to invest again. In the next 7-8 years, we'll need to add a lot of power capacity. And you see that the companies that feed into the real estate construction cycle, like metal, cement, they're doing a lot of capex. You see that most metal companies today are back to 3.5 times debt EBITDA. So they are aggressively investing. You see last year we imported 10% of our steel. The second aspect is that when we think about India's manufacturing share of GDP, we tend to forget that there is a lot of internal demand that we need to focus on. And I'll just take 30 seconds to explain that as we move from, say, a $4 trillion GDP to, say, a $20 trillion GDP at some time in the future, of the 16 trillion of extra GDP, not more than 1 trillion is going to come from the change in net exports. 15 trillion will be domestic demand. This is true even for China. And therefore, we have to be focused on things that consume goods. And the biggest consumer of goods is real estate. Because this is the biggest investment a household makes through its lifetime. And therefore, I think as we think about the capex cycle picking up, we have to be focused on how quickly is real estate construction reviving. The cycle is doing well, but I think we have been losing focus on how fast approval should come through and all that. Once that starts reviving, I think the economy will be fine.
Okay, two quick questions. First, I'll go with Neelkant. Is there any, the government has also been concerned about the fact that the economic growth is close to 6%. It should at least be closer to 7%. I mean, there's been some concern on that fact. Is this a cyclical kind of a slowdown, or are there structural elements?
It is absolutely a cyclical slowdown. It is a self-inflicted slowdown. There were three factors: fiscal, monetary, and regulatory. So the fiscal was because of elections, the government spending took a few months longer than it should have. So the first half of the fiscal year was unduly slow in terms of exhausting of fiscal spending. We have seen a pickup there. So I think we are coming back to normal, and that headwind has disappeared. Regulatory, I think our regulators have become too risk averse, and as the governor very rightly said, that we need to balance safety and efficiency. That's happening in other regulators as well. So at least some of the regulatory tightening is being reversed. On the monetary side, I think we have been unduly tight. There used to be this FRA-OIS spread, which is the actual cost of fund versus the announced cost of funds, like the Fed funds rate and what's actually the LIBOR rate, with which we used to track the stress in the financial system in the financial crisis. In India, the 12-month CD rate is still 760. It is not anywhere close to 625 or 610, which is the 12-month OIS. The 3-month CD rate has actually gone up by 15 basis points in the last couple of months. So the cost of liquidity is very high, and therefore liquidity easing is a very important thing. The RBI is working on it. You must have seen they've done first 1 trillion of OMO, then $10 billion of buy-sell swaps, another $1 trillion rupees of OMO. I think another 2-3 trillion is needed. And then I think the growth rates can rebound to 6.5-7%.
Anish, M&M Group is present across a wide range of businesses and sectors. Do you see any slowdown in consumption?
We have not seen a slowdown, again, a function of the products we've had. Our auto business, our SUVs will grow 20% year over year. Our farm business is growing well. In the fourth quarter, we're expecting a 15% growth year over year. And that's very significant from a rural standpoint. Hospitality, our resorts are at 84-85% capacity. So as we look across businesses, we've seen a lot of positivity, actually. I think Neelkant explained it really well in terms of the short-term impact and what drove that. A lot of those factors have reversed now. So with that, we would expect growth to increase. And if I were to just take a step back, over the last 30 years, India has grown at 6.5% on average. If we look at some of the factors that will change the growth rate that are in play already, the digital stack that drives productivity, GST, which makes it much easier to transport goods across states, a number of other actions taken to drive ease of business, we would expect an 8% plus growth rate over the next decade. That is the goal that India should have. And that is something that's eminently feasible given what we have today. Another factor that will drive that is Make in India for the world. And today we are much better placed to be able to talk about products that we have in India that are of a very high quality, that often are of a higher quality than products made by others in the world, across industries. And that is something that's going to give a much greater fillip to manufacturing in India, which will continue to drive that growth rate up.
Thanks. One last question. Anyone can go first. Does India need its own version of Doge? Doge, the Elon Musk's. I think he's going to toss it to you.
I do think so. I think that, an economy 7 times our size, like the US, has 16 departments. In India, I think there are some 85 departments in 53 ministries. I mean, we have a Ministry of Power, Ministry of Coal, Ministry of Oil and Gas, Ministry of New and Renewable Energy, and the batteries are done by the Ministry of Chemicals and Fertilizers. If you think about electric vehicles, electronics done by Ministry of Electronics, cars done by Ministry of Heavy Industries, batteries done by Ministry of Chemicals and Fertilizers. Clearly, as the world moves towards more industrial policy, I think we need a much better aligned government structure. So I'm not so sure about the whittling down of the government size. Our government is already too small, but it needs to definitely bulk up in some essential sectors, in healthcare and education, for example. But there definitely needs to be a lot of restructuring of the government for us to be more competitive.
Anish, you want to take a shot at that?
I think the key factor is efficiency. Think about how we would think about it in the private sector. Are we running something efficiently? Are we enabling each function in the business to operate at a level where it achieves its objective of serving the customer well? And similarly, that's the same question from a government standpoint. And what we see actually over the last few years is a much greater level of efficiency, because we have seen a focus on driving ease of doing business. We've seen our ministers and secretaries working extremely hard. I've personally seen that in my year through FICCI last year. And I think we're seeing a significant increase in that. What we also have to remember in a democracy, there are multiple stakeholders and there are certain objectives. So the goal of improving efficiency should always be there. That does not go away. But we've got to do that in a way where we do not end up breaking glass in some form.
Anish, Neelkant, thank you so much.
Thank you.
Thank you, gentlemen, for that. Now, as we move on, let's talk a little bit more about the markets. India stands apart from other emerging economies, boasting unparalleled diversity in its business. There are more than 500 listed billion-dollar firms. And as we gaze into the future of a $10 trillion market, where will be the next stock market titans emerging from? How do we maneuver current valuation dynamics to uncover the next big compounders? To unpack this, Prashant Nair, CNBC-TV18, will elicit news and the views of our esteemed panelists. Let me bring them up on stage, please. Sunil Singhania, founder of Bacchus Asset Manager, Utpal Sheth, founder and mentor Trust Group, Rashi Talwar Bhatia, partner and portfolio manager, Ashmore Investment Management India, and Prashant Jain, founder and CIO, 3P Investment Managers.
Sonal, thanks very much for that. I'm extremely pleased to be here to be able to conduct this panel discussion. I think we've got market wisdom of about at least, 150 years? Touching
that old, not
closer
that
to 200 years on this panel here, so it's going to be an interesting one. So the idea, of course, we have 30 minutes, so let's make the most of it. The idea, of course, is finding the next sort of big money-making, wealth-generating stock, in that sense of where the stock will come from, which sectors, etc. But I think, before you thrive, you have to survive. And I think in the recent last 60 days or so, the markets have had can I call it a mini heart attack? So let me just start with that question, whether we are out of the woods already, and I think the audience here would like to know that, whether the our panelists with their accumulated wisdom think that we are out of the woods in terms of what we've seen. Also, before I get into it, really, I want to wish the First Lady on our panel here, I think the First Lady on the panel since the morning, a very happy Women's Day. Rashi?
Thank you.
Well, lovely to have you.
Lovely to be here.
Sunil, let's start with that first. Are we out of the woods with this phase of correction, this sharp sell-off that we've seen in the recent last 2 months?
Thank you for having me, Prashant. I think it's always $1 million question, but again, equity markets, this is not the first time we have seen a big move up and then corrections, and I think this is not going to be the last time. Obviously, things are different. This time, we are seeing this period after 3-4 years of, I would say, really a good sort of a move. Stocks had become very expensive, and I would say this correction, it needed reasons, and the reasons have been multiple. I think we saw GDP growth numbers disappointing, corporate profit numbers still disappointing, and on top of it, we have had this now whole uncertainty about dollar movements, Trump, and so on and so forth. The only good thing is that, every time we have a euphoria or excesses, you need a cleanup, And after the cleanup, normally what follows is very healthy. So I shave off my head, a lot of unwanted hair got shaved off. And I am very sure that now the growth will be healthier and more. And I think that is exactly what the market also leads to. You have to shave off the excesses. And when again it revives, I think it is much more healthier. So I don't know whether we are behind it. I personally believe it is going to be a W-shaped sort of a recovery rather than V-shaped because stocks are still expensive. But I think a lot of technical factors have led to us to believe that maybe, the bottom is somewhere near.
So the W is we've got a big down, then there's a small up, then it's a small down, and then it's a big up. So we're in the second leg.
I think W will be up and down, but with an upward sloping bias.
I see many Ws, not one W.
Yeah, it is going to be multiple Ws.
But it's time to be constructive now, Sunil. Would you say? Broadly?
I think it's time to be always constructive. I think what we are $3.5 trillion. I'm very sure Neelkant has more numbers, but if you see the world, US is 4% of the world's population, 70% of the world's market cap, and 50% of the world's debt. I think somewhere down the line, even if 3-4% moves from these kind of countries to others, it's a $3-4 trillion movement. And even if India gets 5% of that, we have $150-200 billion coming in. So this $20 billion of flows every year, which we make a lot of hue and cry about, I think it will look really chiller in front of it. So I think the only focus we should have is whether this economy is back on track to grow 6.5-7%. If that be the case, profit growth will be at least 11-12%. And your return expectations are, if they are in the low teens or, lower double digits, I am very sure you'll not be disappointed. So you have to be always constructive in a growing economy.
And you have been, Rashi, that same question, are we out of the woods? Quick answer, and then we'll dive into sectors. And I know you have very specific, interesting ideas there. Go on.
So I think that in the large cap space, we are reaching a point where you're starting to see interesting prices or interesting valuations where things are starting to make sense to maybe start nibbling and getting into it. In the small and the mid cap space, we've corrected from being 2 standard deviations above, 10-year history, but we're still a standard deviation above. And I think there have been sharp drawdowns, yes. But, things went up 5 times. So you see a 30% drawdown, you're still in a pretty expensive territory. So I think, to what Sunil said, there has to be some rationalization to what you're paying. I believe in the India story and I believe in the consistent upward trend, but things cannot get out of whack, so to speak. And I think we may be close to having that done in the large cap space. In the small and mid, I'm still a little skeptical about having reached there already.
Okay. Prashant, what about you? What do you think?
No, I would largely agree with what Rashi said. I think the large caps are looking a lot more reasonable, 16 times calendar 26. I think we are broadly there. Small mid caps, I would still be quite cautious. I think the supply of stocks from IPOs should go down 60, 70, 80%. And at some point, even the FI selling should abate. I mean, we don't know when, but at some point it should. I think the local flows should be quite sustained and they should go towards secondary markets and most of it through large caps. So I would say large caps appear to be reasonably valued. One final thing, I think this is a compounding market. I would not, India growth does not mean, to my mind, that you can earn meaningfully different from 10-12% long-term CAGR, because I think profit growth, profit margins, I don't think have room for increase, and profit growth should be around 10-12%. That's what I feel.
And that's an interesting point that you make, Prashant, because 2019 to about 2024 high, September 2024 high, that compounding had gone out of whack. We were running 25-26%, but that's now reverted back to mean in that sense. So eventually, it is that same 12-14%, which you should expect, and that's reasonable to do. But is the froth in mid and small cap still there, Prashant?
I think that high compounding was only because of the low base set during COVID and not because of any other reason. I think the big froth is gone, but I would still not feel comfortable with small mid caps, though I think the vertical fall that you have seen, maybe it's behind us and we should see slower underperformance, but maybe for extended periods.
Utpal, what is your sense?
Thank you, Prashant. First of all, I would say it was not that we had a mini heart attack. I would say it was a stress test. Second, I would say that let's step back a little. The quantum of change and the pace of change that is now taking place at a global level is really unprecedented.
Utpal, can you hold your mic a little closer, please?
Okay. Is this better?
Please.
Yeah. The quantum of change and the pace of change that we are seeing at a global level is really unprecedented. This will have impact on growth, on risk, and on profitability. It will play out over a period of time. Therefore, factors like deglobalization or AI disruptions, and there are just too many factors. As an investor, should one be afraid of that, or should one see the opportunity behind that? In the past, whenever such a change to the global world order have taken place, whether it was the Bretton Woods or any such other major change, then those changes have resulted in phenomenal opportunities. I think it is wise to be able to look for those opportunities in the times ahead.
I think you've taken I wanted to just do one round on this as well. Are we, because the change is phenomenal, right? The significant amount of news flow, how much is noise, how much is signal, we don't know. How much should we read into it to really make investment decisions? Does it affect investment decisions? Who will be the winners? Who will be the losers, etc.? So I don't know if any of you feel strongly about this. Sunil, if you want to take that. Will it really, the changes we are seeing, you said, right? US is so much capital and some may come here, but they want it all, it looks like.
So I'll just start by, just sharing something which was there on the WhatsApp. So on Monday you said there will be tariffs. On Tuesday you said there will be no tariffs. On Wednesday again tariffs. Thursday again no tariffs. Friday again tariffs. And Saturday, Sunday play golf. So I think the relevance is slowly getting lost, because if every day you come and arm twist, at some point of time the guy is going to say I don't care, and I think that is what is happening. China has already said that you can't threaten us, you can't arm twist us. Canada has also put retaliatory tariff, and I think the same thing will be done by a lot of other things. And if you see the impact, whenever they announced anything, now the impact is reverse. Yesterday the European markets were in fact up. Yep. The other thing is, there is this concept called Trump put. Trump doesn't like markets to go down. And at least in his earlier term, this Trump put worked, that he could sell puts and keep, because Trump will ensure that the markets don't go down. And I think this is what is happening. The moment the markets correct, they defer the tariffs or they announce something else. So I think the relevance is being lost, frankly. The other thing is, for how long, you can just keep on bossing around. So I think maybe, I don't know the rationale or whatever it is, but I think the world will adjust to it. And, no one, after a point of time, will take dadagiri, so to say, I think even if you shout at your house help or driver for 2 times, the third day he will not report to work, and these are presidents, you can't ridicule presidents. So I am frankly, not reading too much into it. There will obviously be news flows which will impact market, and that's why this W-shaped, the markets might go up, and then there might be some news flow, something which will cause some concern. World is still not a a very stable place economically. So irrespective of Trump, I think what we need to worry about is whether the world is coming back on its feet or not. But I think this Trump thing has gone too far, and we just
although he's not once since taking over this time tweeted about the stock market, and the earlier avatar every day in the morning he would say
because the stock markets were up since he took over. It's only yesterday that they're now below his price. Now wait for 2-3 days, you'll know.
No, point taken. The other implication, though, I mean, directly, what impact tariffs, etc., is a different thing. But as you said, though, is the world doing better? Many parts of the world are now starting to look like they're doing better. Europe, for example, is a case in point. Germany, after, I think decades, is now starting to say they want to do well. They want to spend on infrastructure, military. China, this deep-seek thing is. I mean, so the last 4-5 years in emerging markets, we used to say, Tina, there is no alternative. That seems to be changing. There are options. Argentina, for God's sake. Japan, I mean, not an emerging market economy, but I don't know if Rashi, Prashant or Utpal, you have any strong views on this. I mean, and then we'll get down to what you like and where to find those ideas. Please.
So, I mean, I think all four of us here are India specialists, so to speak. Yeah, I think you're right. The world's getting to be a slightly better place. And maybe it should be. We've had 4 years of practically there being just US, Japan and India being the stalwarts standing there for the equity capital markets, and it cannot be this narrow.
Right.
So I think it's healthy for global markets in general to have better alternatives where you have more choices. So.
Any thoughts, Prashant? You want to weigh in? You're a big macro. You do. I know. 20 years we've spoken. You've always said the price of oil is all important. The price of oil is now down. I mean, that is one of the consequences of everything we are seeing out there. Go on, Prashant.
No, I think India's correlation with world GDP growth, I mean, many economists don't agree with that, but what I have seen that India is on its own path. It's growing around 6% plus minus 0.5%. I think that should sustain, and India has delivered that growth in different macro environments, high interest rates, low interest rates. I think that growth is pretty secure to my mind. I think it is just that the expectations from India, what happened last 5 years were being extrapolated, and I think that's where things got overboard. So, I mean, I would expect India to do reasonably well over time what it has done for the last 2 decades. And as Rashi said, I mean, I have nothing meaningful to add on markets beyond India.
Okay, so let's get down to, as you said, as Rashi said, all of you are India specialists. So let's find ideas, right? And I think that's the idea behind this panel discussion. Sunil, you go first. Where is the next billion, trillion, multi-trillion dollar idea going to come from? Which areas are you sort of most hopeful of, constructive on?
So, I think it's frankly very, very tough question because sectors and companies which look good are still not cheap. Obviously there are a lot of headwinds, so if you look at IT, there's a tailwind in terms of currency, but there are headwinds in terms of technology change, maybe some regulation in the interim which Trump might bring in and so on and so forth. So I think it's a little difficult at this point of time. The only thing I'll say is that, we are obsessed into making, multiple returns or multi-bagger returns, and we lose the plot. I don't think we are in a phase of the market where you're going to compound at 20-25%, where you will be able to double your money every 3-4 years. I don't think we are in that kind of market, because growth rates, even if we come back, will be 6.5-7%. I agree with Prashant that the long-term profit growth will be 11-12%. And we are starting with not a very cheap market. We are not starting with an 8-10 PE market where the PE can expand, and therefore you have higher than the corporate profit growth as far as returns are concerned. So I think we are basically looking at somewhere in the region of 10, 12 to 15% returns. I believe that there are pockets which have opened up. Chemicals is one space which also get benefited because Europe was a big sort of destination for India, and Europe was really struggling. One uptick of what Trump has done is that all the other countries have woken up, that we can't depend on US, and now they are trying to chart their own territory. And I think Europe is one where they are saying, okay, let us do a bazooka. China is saying, let us do a bazooka. We want to ensure that our economy, irrespective of what Trump does not get impacted. So I think that would be one. Metals is one space. These are small sectors, but they definitely add alpha. I think financials look pretty decent. Growth rates will be lower, but corporate balance sheets in India have never been as healthy. NPAs are not there. I think the banks have really done quite well. So financials are one space which look good, but I think if you want to create alpha, maybe these 2-3 sectors can add 1% to your returns. But I don't think we are in that phase where you will make 20-25% return every year for the next 3, 4, 5 years. I don't think we are in that space. So we should not focus on making multi-bagger returns. We should just focus on consistently trying and beating that 10-12% long-term average.
Sunil, with the kind of returns you've given,
yeah,
I don't think your investors are going to accept 12-13%.
We will find some stocks, but I'm talking about the portfolio level. You can't have every stock in a portfolio going up 3, 4, 5 times. And that phase was there. And I think it's like, the T20 matches, first 6 overs you have to hit. That has been done. Now you have to protect your wicket. So maybe the next 10, 12 overs, the next 3, 4, 5 years, you just have to take singles. And that is the phase we are in.
Okay, so chemicals, metals, financials, three areas broadly.
Financials in the big sector, but I'm just giving you examples that there are some small pockets which are opening up, which can add a little bit of alpha to your portfolio.
Okay, so financials, of course, is well discussed, but chemicals and metals is largely like a valuation-led argument. Demand is picking up. It's a combination of both.
So again, if you look at Indian metal companies, I think the debt-equity ratio is one of the lowest we have seen. Domestic demand is pretty healthy. There is no challenge. They are dollarized, so the rupee depreciation helps a little bit. We are going to definitely see reconstruction in the world in terms of the war-torn areas. So one thing good about Trump is that at least he will ensure that the conflicts are reduced. There will be reconstruction, whether it is the Gaza Strip, whether it is Ukraine and so on and so forth, there will be demand. China has already started, having a big impetus, plus they are also trying to curtail production which is not viable. That is also there. And I think as far as India is concerned, the demand of 7-8% even for these metals will go on, and we are one of the lowest cost producers in the world. It's a small sector. I'm not saying that you have to have 15-20% of your portfolio in metals, but even if you have 7, 8, 10 and they end up doing 10% more, you add 1% to the alpha. So that looks good. And I think the same thing is there with chemicals. We have survived the worst. Europe is big. There are a lot of Indian companies which have gone ahead and bought global companies, and when these turn, I think the impact on profitability for some of these companies is going to be huge.
Yeah, absolutely. And I think there are more assets which are coming up in Europe up for sale as well. So maybe we'll see what happens. But you're absolutely right. We've already seen some acquisitions coming through. Rashi, what is your big bet?
So, let's keep valuations aside for the time being. Let's look at where we're going to see better than what earnings we're expecting. And in Sunil's perfect world of the W-shaped kind of recovery that we see, we'll get the opportunity with the valuations. And, in terms of a trend that I'm picking up that is changing, and a shout out to Neelkant on the panel before who mentioned larger participation of women in the workforce. So 2019, the participation of females working was 23%. Last year, 2024, that was 37%. This year, we're supposed to get to over 41%. 2020, more women went to high school than men did. And therefore, as more women enter the labor force, consumption patterns are changing, and changing dramatically. More women working, women have always managed household finances, but that's a very different kind of spend versus when they're earning themselves and spending on themselves. So when women earn themselves and what do they spend on, right? It's convenience to make life easier at home, and that could come in the form of, say, quick commerce or e-commerce, gadgets, electronic gadgets at home, because you need to have more time on your hands to be out. It's personal mobility, and we're seeing that probably with scooters, would get to smaller cars, etc. And it's also on the personal well-being. So whether it's fashion, whether it's beauty products, skincare, etc. And fashion and beauty are already a $110 billion market, of which beauty products is only $20 billion, which is expected to get to $90 billion by 2037. And 40 billion of this is supposed to come from the e-commerce platforms, right? So these are very large trends, and we have seen markets like South Korea or the US, what has happened when these trends have taken place, which are now taking force in India. To me, these are large changes, and we will find a lot of winners coming out of this space. Obviously, you have to look at valuations, you have to look at what the status is, what the growth status is. But yes, I think this is one opportunity which I do believe is playing out as we speak.
Specifically, you're saying beauty as a category is something to watch out for, right?
BPC, products, because BPC, I think it's fairly under-penetrated even today. Fashion, see, if of 110 billion, 90 billion is already fashion. Yeah. BPC is to go from 20 billion today in 2025 to 90 billion by 2037. So that's...
Are there enough listed entities? I mean, everybody, all the large guys have it, but I mean, for them, it doesn't move the needle. So you need something concentrated in that sense.
So, absolutely. And I think the large guys are realizing they didn't have exactly what was needed. They were sitting on their old, brands and working off that, and now are starting to look at more on the private space to acquire. There are obviously some listed brands which do more distribution. There are some that are getting into the manufacturing side of things, and I think we're going to see more and more come out as we go ahead.
And acquisitions in that space as well, right, from the larger guys?
Absolutely.
That we are seeing, and we'll see more, some in the play. Prashant, what would your ideas be? And of course, I mean, with the disclaimer, and I think all of you are saying the mantra is keep expectations low. Don't look for multi-bagger. That it was still, as Sunil said, where do you find the alpha?
So these are compounding markets. I don't think these are markets that offer meaningful number of multi-bagger opportunities. If you look back, multi-baggers have materialized even when a new business model was listed in India, which is not happening anymore because they go to the private equity route more often than not. Or when the markets were in a deep downturn. Or when, let's say, consumption is not that cyclical, but capex can be deeply cyclical. So in 2000, when capex was down for 10 years, you could find multi-baggers there. I don't think in this market there are multi-baggers to my mind. This has been a narrative-driven market. If you look at last 5 years, 3 out of 4 investors have joined the markets for the first time. So, and they have been influenced heavily by narratives. So I would rather avoid those narratives because most narratives have been overplayed in terms of valuations. Yet I would say, as Neelkant said in the previous session, I think capex should grow faster in India than GDP. I think consumer discretionary space should also grow faster than GDP, and Rashi also referred to a segment of that. I think, however, I would simply also be careful that top line growth alone need not lead to profit growth. So we have to be careful to buy into categories where there are some entry barriers, some competitive advantages, and but generally I would say these are compounding markets and there are no obvious mega return kind of opportunities in this market tomorrow.
But industrials and capex is the spot where you think maybe market is underpricing, expectations have dropped off there. Especially after the budget, etc. People said, well, maybe the regime is changing, it's more consumption, etc. And after a few years of very strong growth. But you think, as Neelkant also pointed out in the last session, that is not true. So that still remains a spot to look for ideas. Capex and industrials.
So I think, yes, industrial should grow faster than GDP. And only thing is you have to be careful. The margin expansion in some of these companies looks to be unsustainable. So, but still, I would be quite alert to look for companies that have some advantages, because that space should grow meaningfully faster than, so that narrative is right, it just got overvalued. But if it again offers you reasonable valuations, I think there is merit in that space. So I would agree with that.
I would be remiss if I don't ask you about PSUs, Prashant, PSU banks, etc. I mean, stocks have fallen a long way now. What's your sense? How do you think about that?
So I think we should, as I have said multiple times in the past, it's wrong to club all PSUs together. There are PSUs that can compete well in the marketplace, and there are those who are unable to do so. But even the good ones, I don't think there is any meaningful mispricing at this point of time. Please remember, these stocks have gone up 5x to 15x. And so I would say, but there are, in the large cap space, I don't see much excesses also. That's the good thing in this. In the small mid cap, there are still excesses, and most PSUs are large cap. So I don't find the valuations excessive either.
Fair enough. Utpal, where are you looking for ideas? Alpha.
Instead of thinking about sectors, I would say that this is the time to think about superlative management teams who've demonstrated the ability to pivot, the ability to adapt, who are working on expanding their addressable opportunity and elongating their competitive advantage. There are very few of them, and this kind of market volatility actually helps in being able to buy them. And I fully agree with what has been discussed earlier, that we are looking for compounders here rather than multi-baggers. But I feel that the compounding longevity will be better with these kind of superlative management teams.
And we had one before, right before this panel, right? Anish was on stage, and fantastic job there. But anything specific, Utpal? I mean, since it's about superlative management teams, I don't know if you want to put a few out there.
So we are looking for management teams who are able to embrace the disruption, who are not dependent on economic growth for their growth. We are looking for management teams which can take out costs, which can think of very different price points compared to what they've been thinking of earlier. I think those would be the characteristics to look for.
Fair enough. I think we are right on time. I think the message from the panel is, if you want to be happy in markets and in life, keep expectations low. That's I'm summarizing it correctly, Sunil?
I think it's always better to have low expectations because, if it comes better, you're always happy. But we also have to embrace the reality.
Right.
I think to expect CAGR returns which are extraordinary, then, I think it will all boil down to no one will set up industry and no one will work. Everyone will just want to be
now you're getting into a...
It's a fact, So I think you have to be realistic about it. But see, in the broad scheme of things, we could have said that, things were very expensive last year, but no one came out and said that. Right now we are all trying to introspect. That's the nature of the market. Things definitely are decent, but at the same time there are challenges also. I'll just highlight one challenge. A lot of corporates are also taking decision now based on market cap of that particular sector rather than profitability. And we have seen that happen in paints, cables, some other sector will come up. I don't think the size of profit is what is driving those decisions. Maybe the size of market cap is driving those decisions. And that will put pressure on the existing companies. On the other hand, because the markets have not been very, very buoyant, the ability to raise capital either by way of private equity or IPOs will reduce. And that will lead to reduction in competitive intensity for the already existing players. So it's going to be a very interesting next couple of years. And I think that is good because in a market which was like what was last 2-3 years, even your mistakes made money. And now, it's really going to be a good grind. And I think that is what you need if you want to accept the challenge as a portfolio manager.
Intermittent bursts of reality, and we'll continue to lean on all of you as we navigate over the next couple of years. What seems to be slightly different markets is what we've had, go-go markets we've had over the last few years. Sunil, Rashi, Prashant and Utpal, thank you very much for being lovely guests and all those insights, some ideas here for the audience as well. And thank you very much for being a wonderful audience. Thank you very much.
Our panelists. Thank you, Prashant. India's IPO pipeline is heating up, with over 5 lakh crore in offerings set to hit markets in the next 3 to 5 years as PE and VC investors seek exits. While listed companies may want to raise more growth capital, promoters of unlisted companies may want to tap the capital markets as well. So can bankers really marry promoter dreams with investor expectations? To take this question forward, I would like to now invite on stage Anuj Singhal, CNBC Avaz, and Ashwin Mohan from Moneycontrol on stage. And to help us decode all of this, our panelists for this section are going to be Rahul Saraf, Head Investment, Bank City, GV Ravishankar, MD, Peak 15, Sarthak Mishra, Partner, SoftBank, and Jimmy Jacob, MD and Head of Equity Capital Markets, Jefferies, India.
Hello. An IPO is like a negotiated transaction. The seller chooses when to become public, and it's unlikely to be a time that is favorable to you. Famous words from none other than the Oracle of Omaha, Warren Buffett. On that cautionary note, let me welcome you all to this very exciting IPO panel at the first edition of the Moneycontrol Global Wealth Summit. I'm Ashwin Mohan, joined by my co-moderator, Anuj Singhal, and over the course of the next half an hour, we will try and dissect the 5 lakh crore IPO opportunity in India. Let's quickly set the stage over here. Last year, there were 337 IPOs in India, both on the mainframe and the other exchange. India rose to the top in IPO volumes for the first time, marching well ahead of the US, 2.5 times that of Europe. $19.9 billion, those are the IPO proceeds, the biggest from India in over 2 decades globally. That's as per the EY Global IPO report. And therefore, Anuj will agree with me, it's no surprise that we are sitting here with this very exciting panel from the advisory world as well as the world of investors. Let's quickly dive in with my first question to Rahul of Citi. Rahul, a very, very exciting pipeline of IPOs ahead of us in this year. We are looking at billion-dollar IPOs across various sectors, whether it's Tata Capital, whether it's Lenskart, whether it's Temasek-led Manipal hospitals. All big deals, but isn't it time for a reality check as well? Because if you look at the data, there are around 26 companies that have got their approval from the market regulator SEBI between April to the end of December to launch their IPOs, but none of them have launched as of March 3rd. So there seems to be a bit of trepidation in the markets. Blame it on tariff wars, blame it on FII sell-offs. So what's your take right now? Because many of us over here have discussed that towards the end of 2024, we all thought that 2025 will be an even bigger year. Do you still subscribe to that view, Rahul?
Well, I'm a banker, eternal optimist. I think 2025 could be a bigger year. We have, in the IPO pipeline you talked about, there are about 1.5 lakh crores of pipeline which is already there. Mandated, soft mandated, likely to be mandated in the next 12 months. Question is about market and timing. The good thing is a lot of these IPOs
Rahul, can you please hold the mic closer?
Sorry.
Yeah.
The good thing is a lot of these IPOs are likely to be offer for sales. So the business doesn't need capital immediately. So the issuers can time the market. And if there's a market which is soft, which is what it is today, people have the luxury and the flexibility to defer it by 3 months or 6 months if they need to.
Okay. At this point, it's also important to point out that while the IPO frenzy looked good, it's now looking quite bad, Ashwin. I was just looking at the data. 70% of the issues of 2024 are below their listing price, and 45% issues are below the IPO price itself.
It's an end to the frothy era.
Absolutely. I have a question for Mr. Ravishankar. Since Peak XV has managed to sell a lot of investments at peak, partially exit, a case in point being Mamaearth or Honasa. Do you think we have reached a stage where IPOs, since we say that IPOs are in 4 stages, good IPOs at good price, good IPOs at bad price, and bad IPOs at bad price, and then bad IPOs at bad price. Did we reach a stage where a lot of good IPOs came at bad price, and did that actually hurt the market?
First, thank you for having me here. At Peak 15, we've had the privilege of seeing maybe over 30 IPOs in the last, 19 odd years we've been doing this, and maybe 16 in the last 5. So I can tell you, this is more art than science, unfortunately. I've been in IPO situations where bankers and advisors have pitched a certain price. We all believe that would be fair price, and then 6 months later, as markets correct, you're IPOing at 50% the price and barely making it. I've been in one such IPO, and then to see that same company over the next 2 years double the price. So these are journeys that are very hard to call. But I would say one thing, we all as an industry, as private shareholders, need to appreciate that IPO is not necessarily the end goal. It's a milestone in the journey of a company. And so when you see it that way, then you stop thinking of it as the place you maximize everything. Because there have been situations, and we have been in companies where, we invested, but we were not the primary shareholder, and the IPOs were priced at a price where after 4 years, people have made no money, and it was very, very clear they were priced at the top, and, those decisions actually hurt sentiment of investors, retail shareholders, and others, when they're made like that. But we also need to know that everything is two sides. People are willingly buying, nobody's thrusting anything. IPOs should fail if the price is wrong. So I do think it's a bit of a sentiment issue. You would not find that happen this year. For example, I don't think there is a way to maximize price in an environment like this. So I think these are cycles, but you're right. I think there are good IPOs at bad prices, and we should be watchful of that. And it's in everybody's interest to educate what the right way to do this is, which is long-term sustainable.
Right. The lens, I think, will definitely be on pricing discipline. I'll quickly get in Jibi over here. Jibi, so you've been part of the syndicate of bankers for IPOs that were launched in varying market conditions, right? So you were part of the syndicate for Vishal Megamart, which launched last year, saw stellar returns for its private equity investors. You were also part of the syndicate for Dr. Agarwal's, which was launched during a rather volatile and choppy market scenario. If you look at the optimism with which 2024 ended, the last 2 months have changed quite a lot. What are some of the big key needle movers on the ground that you are seeing as an iBanker?
Yeah, I think first and foremost, what you have to realize is IPO, kind of feeds on what is happening in the secondary market. It's more of a product that feeds on with the sentiment. While 2024 was great, I think just to give you some examples, from 2019 to 23, India saw around 15 $1 billion deals across IPOs, QIPs, and blocks. 2024 alone, we saw 11 deals, right? So, of course, it was the result of how the market was behaving at that point of time. Right now, I think as we see, where the market is, I think first 3 months, we are around 8 to 9 IPOs on the main board, raising around $1.8 billion. Of course, 24 is a very tall ask of $20 billion. Do we see 25 crossing that? Unless the market rebounds very quickly, might be a bit of a tough ask. But I think the encouraging part is in the last, say, 2 months, when the market has been bad, we have seen situations where more than 9+ companies have awarded $1 billion+ IPOs, right? So the issuers are not slowing down. We do expect that we are maybe, if just kind of touch the bottom or nearing bottom, things will quickly revive from here on.
Okay, coming to Sarthak now, and you've been a pioneer in terms of startup IPOs, a lot of them. The word doing the round right now is that at the start, the startup promoters have a vision and investors have the money. By the end of the cycle, it's the other way around. Going by the recent price fall that we've seen, of course, we're all talking about the current market in which the market's not been charitable to anyone. But what's your sense about the startups coming for IPOs this year? Will perhaps have Zepto as well come into the market after seeing the success of Zomato and Swiggy. Your thoughts?
So look, I think I don't maybe have as much experience as these gentlemen, but I started my career around the summer where Facebook went public. And this was the summer of 2012, and I was a early banker in Silicon Valley, and Facebook went public at 100 billion and then quickly collapsed to half from there. There were companies like Groupon and Zynga, where some people may not have heard in the audience, that had market caps of 15 odd billion. And that summer, no IPO happened. There were 15 or 18 companies that were supposed to go public that summer, and they didn't go public. That memory is quite fresh for me, and so I wouldn't be surprised if we have something similar for a period, and I think that's totally fine. I think if you had taken that basket of companies and invested in that basket of companies, I think you'd be very happy with how that has played out today, 10, 12, 15 years later. So I think we all look for the excitement, hope for the excitement that things will happen in a quarter, 2 quarters, but like GB was saying, this is a very, very long journey.
Right. So peak 15, GB, you guys have been around for a long time, for almost 2 decades, backed about 30 IPOs and around 15 or 16 of them in the last 5 years. So very active player in the VC ecosystem. My question to you is, how has the game plan changed when it comes to valuing new age companies? That's something that the audience would like to know. Also because I keep hearing this constant refrain that nowadays there are startup founders who are ensuring that we leave something on the table for investors. And correct me if I'm wrong, gone are the days when one would expect an IPO to be priced at a significant multiple over the last funding round. I think that mathematic has gone out of the window. We have seen IPOs which have been launched at flattish valuation, perhaps in some cases even slightly lower than the last round. So valuation of new age businesses, what are some of the challenges that you're facing in this regard?
Yeah, I think in this regard, the private and the public markets work quite differently, right? So, as an early shareholder in a company, most times we enter a company when the economics is not fully proven, the growth rates are very high. So we're not investing for compounding, we are investing for a small probability that this company is a very large company, right? Which is a very different thing when you come to the public markets. When you invest in a company, you're hoping to compound your capital in that journey of a public company. And so the big difference when we think about private and public market valuations is people just look for different things, look for different return profiles. And the margin of error in public markets is much lower compared to how we model our private portfolios, right? So there's a huge difference. And increasingly, as more experience exists in the market of tech companies going public and how they do or don't do, I think founders are starting to understand that, look, the way to do this is not how you do this in the private markets. In the private markets, usually, maximum price is preferred, right? In the public markets, people are starting to think about, look, who will be the shareholders that will not, dump my stock right after? How do I find the right long-term shareholder who can be a part of this journey? How do I make sure my IPO is seen as a successful IPO? Because after that, you have to live with the price on an everyday basis. Remember, as a private company, you have these marks once in 18 months, 24 months on what your business is worth. As a public company, you're seeing it every day, right? So very, very different journey. So I do think founders are starting to understand and accept that it is not about maximizing the price, and which is why I go back to saying it is a milestone, it's not a destination. And that milestone should go well, part of which is when you list, there should be a nice pop and people should feel happy that the IPO did well.
Okay. Rahul, I want to come in on this to Rahul. Then what's the role of the merchant banker in terms of choosing the anchor investors or in terms of choosing the secondary investors? Because nowadays we see a lot of trepidation in the market when a lock-in is coming near. Everyone is getting afraid that a lock-in is near and these guys will come to sell. So now are you looking at the profile of investors, even if it means you need to tell the promoter that, look, we need to price this issue slightly lower than what you may have thought, but let's focus on the quality of investors more than just, look at the subscriptions or look at the pricing of the issue.
Yeah, so Anuj, that's the most critical thing in IPO. A lot of it is process, a lot of it is administrative piece, a lot of it is legal. But the real value that bankers provide is judgment on valuation, judgment on what's the positioning of the equity story, and choosing the anchor investors. And the anchor investors are extremely critical because they are not just large investors in the anchor book taking a call early, but they're also influencers. And also they are very, very important because they could have an interest in the main book and they could have an interest in acquiring post-listing as well. So people who are going to be supporters, who are going to be rock steady in the book for a long period of time, longer period of time than most others, very important to have that investor class come in the anchor book. And like you said, allocate more to them, allocate judiciously to them. And even if it means a little bit lower on the price, we actually recommend very highly to actually have the right anchor investors in the book.
Rahul, I'm going to extend that point and also pose the same question to GB. GB, if you look at FII data, they have taken out more than 1 lakh crore this year in January and February, right? And Incidentally, Chris Wood of Jefferies, your firm, he was also surprised at the massive sell-off in Indian equities. But on the other hand, the gap has been filled to a great extent by the DIIs. And that's the point that the SEBI chairperson too, earlier today, in his first public appearance at the Moneycontrol Global Wealth Summit, alluded to. So the DIIs are playing a major role. The question I want to ask you is, and don't give me a diplomatic answer over here, what is the mix right now as far as the anchor book is concerned? FIIs versus the DIIs. Are the mutual funds still playing a very, very critical role?
Yeah, I think very valid question. But I think if you just take a step back in the IPO process, you end up meeting around 200 to 300 odd investors, which is just not foreign investors, but also a good mass of local domestic investors, which is mutual fund insurance companies, right? And finally, as job as bankers is to kind of triangulate all the feedback and come to the right price. I think by regulation, 33% of what you allocate in an anchor book is reserved for mutual funds, right? So you can understand 1/3 of the book has to be minimum given to mutual funds. So that input on value is very crucial. So I would say it's a triangulation of all the feedback, not only of domestic investors, but also of foreign investors. On the FIs, selling on the secondary side, but if you just look at their primary investment, there is a bit of a rotation that has happened. Majority of them has kind of diluted their stake in listed entities and kind of come in to that same extent or close to that same extent in the primary markets. So what we are seeing is that FIs are equally important as domestic investors, but since there is 1/3 reservation, there is a lot of sanity in pricing. I don't agree with the comment that, IPOs are getting priced wrongly. If you look at the top 20 IPOs, the median returns has been around 25-28%, which, if you're getting the pricing wrong, it should be more to the negative, or if you're getting the pricing wrong on the other side, it should be popping like 50, 60, or maybe 100%, right? So I think the pricing is in our view, very reasonable. What is also happening is...
I want to come in on this. The problem is that, most of these IPOs are getting subscribed 100x or 200x. So, while you're comparing from the issue price, we should also be looking at from the returns from the listing price. I agree with your point that, most of the IPOs might be up from the issue price, but it may not mean a lot for secondary market investors who are trusting their money in a lot of these good quality IPOs. And over there, you'll find that a lot of issues are actually below issue price. Sorry to interrupt, but just wanted to make that.
I think, Anuj, you make a very valid point, right? So there are two price points. One is the IPO price, which is what I think as sellers and bankers we determine, and how it lists and who buys at that. You can't really control the return profile from there on. But if you just take a step back from the highs of the market on the secondary side, right, you saw market around 5.5 trillion, and today it's 3.7 trillion, right? You saw a 30% destruction in value. So as the tide goes down, whether IPO company or secondary listed, everything will come down. So I think singling out IPO alone as a big cause of value destruction is not right, is what I'm trying to say.
I think, just to add to that, Anuj, the primary markets or the IPO markets, the fundamental analysis is much more compared to liquidity flows and behavioral analysis. In secondary markets,
Rahul, you are very soft spoken. You need to just keep the mic closer.
Yeah. I was saying that in the primary markets, the fundamental analysis that investors do is much higher as against the flows and liquidity driven price impact. And in the secondary markets, that liquidity driven price impact is much more. The behavioral piece is very, very active as well, which is the phenomena across the world, but the secondary market is more active. And that has an impact in the secondary markets. Over a longer period of time, we think all of it evens out. So depending on what price points that you look at, what time frame that you look at, you'll find different answers.
Okay, Ashwin, I just have one follow-up here because of distinction between primary and secondary market has been made. Sarthak, there was a lot of noise around the Paytm IPO, the Zomato IPO, and we had a lot of them come on air and say that we could have priced it higher, but we priced it actually lower. And after that, we saw the destruction in the secondary market. And after that, we have seen the promoters actually maybe take a lesson that secondary market works differently. And all of them are now talking about profitability, path to profitability. Do you think that has been a major shift in the last 2 or 3 years?
Look, I think absolutely cost of capital went up around the world, so that there was no other option but to say, look, capital has gotten expensive for me, so I have to make the most and take my existing capital as far as possible. And so the time from when some of these companies went public, capital was, the 10-year was at basically 0 or 1%. and today the 10-year is, let's say, at 4.5%, which has made the capital very, very expensive. And so I think all entrepreneurs around the market took a call to say, okay, look, how do we make our money work longer? And I think that's absolutely the prudent thing to do. I think tomorrow, if you took the cost of capital down further, like maybe there are in some pockets of AI where cost of capital today is very, very low, I think there you are seeing extreme willingness to invest for the long term, even today in a high capital cost market. So I think these are smart entrepreneurs who are looking to do the best allocation of capital, which is in some way a big part of their role as CEOs. And they are playing the game on the field, frankly. So I have a little bit more empathy for their situations, maybe, but that's how I see it.
Well, it's clearly a tough market out there, you know. On that note, GV, let me rope you in. Over and above Mama Earth, you've also floated Ixigo, Office. That was an IP which was a category creator of sorts. You know, taking off from what Anuj and the other panelists have spoken about, give us a sense of what are some of the lessons that you've learned on the ground as a VC. And when I say lessons, I mean perhaps you could also allude to some of the mistakes that have perhaps been made, because those are the insights that the crowd would really like to sort of look at. And the second question would be, we spoke about the DII versus FII perspective. Has it now become almost mandatory for there to be a DII/mutual fund heavy anchor book to ensure a pop on the day one of listing? Or would that be an exaggeration?
No, our experience, and maybe I'll start with the second one first, is, look, DIIs have just become so much more important in the scheme of things. And honestly, they, in some sense, and maybe this is unpopular to say this, they control pricing to an extent because of this. You know you have to fill up a book. And there are now very, very large DIIs. And they can write a $100, $200, $300 million check in a single IPO to make it happen. And so they are kind of pushing very hard for a more attractive price and so on. So I do think, they've become very important in the scheme of things. And it's a good balance. It's not to say that is right or wrong. It's just a good balance.
Sorry to interrupt, but are you perhaps alluding that the DIIs are maybe in certain cases also, tightening the entire valuation expectations that perhaps the team would have originally started off with?
Yeah, I'm sure. Look, everybody wants, like, as a buyer, you want the lowest price, as a seller, you want the highest price. So everybody has to do their job well, and so they do a really good job. So they do a good job for all the, retail investors that they manage, right? So I again, no complaints about that. I do think they bring stability. They have a lot of liquidity now, and they are important stakeholders, right? So, by the way, that has been one of the learnings, that you have to have the right DIIs, participate in your story. And they also have much better, eyes on the ground, knowledge of what's going on, and it's
any mistakes from the Peak 15 experience that perhaps you would like to share?
I mean, it's always
any learnings or challenges?
Always learning lots of mistakes. We've had companies that go public very early when, at a time we thought, okay, this size is enough. A company that's 500 crores, 1,000 crores revenue and somewhat profitable, and you take it out assuming that it's going to be a compounding journey for many years, only to realize that it prices at 2 or 3 or 4,000 crores and there's just no liquidity in the market. So when I say, milestone versus a destination, we've made the mistake of thinking this is a destination, when it goes public, we'll sell and go and so on, because we've served our time, only to realize that most things don't have liquidity at those prices. So what we've learned is, unless you can have companies that are valued maybe 2.5 billion, something in that range, there is not a lot of liquidity in these stocks. They are public companies, but like private companies just listed, not really traded that much, right? So that's a mistake. So.
Okay, Rahul, one question to you now. We have stopped discussing the government IPOs, the PSU IPOs, which was big in the last bull market. Now, of course, we have the new SEBI chief who's spent time at Deepam. Do you expect over the next 2 years, and the government has been lagging behind in its targets.
Disinvestment targets.
Disinvestment targets.
Yes.
Do you see some blockbuster government IPOs which could generate a lot of interest from the public?
The fees may not be that handsome.
Yeah, fees will not be anything. But
on a lighter vein.
No, I think what is most important is capital formation, ability for public investors to participate in good companies. A lot of the Maharatnas and Navratnas are already listed in the country. And government has actually had a program to sell down in those companies over a period of time, which we believe would continue to be the plan for the government. There are not too many large private companies, privately held companies by the government, which are not listed at this point. But from a government perspective, whether they have the resolve to continue to focus on further sell downs and own less of the PSUs, the answer is yes.
Anuj, let me rope in Jibi over here. Yeah. Rohit, Rahul, point taken. Jibi, last year there was a time, and this is during the IPO fervor, when, there were many M&A advisors and they were getting frustrated because many of their M&A mandates were being converted into IPOs. Because the promoter said, hey, listen, I'm getting better valuations over there, so let's not go through the strategic process, let's hit the markets. In today's environment, GB, where a lot, like we all have discussed, has changed in the last 2 months, is there a reverse scenario going on? Are you seeing that? IPO aspirants perhaps looking at the M&A option? That's the first question. And very quickly, if you would like to weigh in on the entire tech IPO debate, what is the most important checklist factor when it comes to, say, a VC and a startup saying, right guys, we are mature enough, let's go ahead and do this?
Yeah, maybe I'll take the second question first. I think what we are seeing as a fundamental shift is, earlier, maybe in 21, 22, we had companies which were talking about profitability in 3 to 5 years, wanting to do IPO. I think that narrative has changed. People are approaching or discussing IPOs when they are just about breaking even or turning profitable in 18 odd months. So I think profitability, as Anuj was also asking, is become the key monitorable. So that's been a big fundamental shift. We do believe that 25 and 26, you will see far more companies coming out from the new age bracket, approaching the public market, right? Really sizable ones. Couple of them has been already reported talking about IPOs. So that's a, shift on the IPO part. Coming back to your first question, Ashwin, if I got the question right, you were talking about
I was talking about
M&A.
Yes.
Yeah. So, yeah, I think, as sellers, you keep all the optionality open. There are situations which turn from M&A to IPO and vice versa as well. I think since you have a very sophisticated set of investors or sellers there, they do recognize that markets moves in cycles. If you just take a quick snapshot of the overall IPOs, let's say 1,000 crores plus IPOs, you will see 78% of the IPOs had a private equity investor there, right? So these are companies very mature in their thinking.
Right.
And if I look at 2022, because that was 1 year which was difficult as 2025 started off to be, you had just 3 months which accounted for 60% of the entire IPO volume in India. All right. And still we saw close to $8 to $9 billion getting raised, 35 odd companies going public. So timing is everything. Is that what we are advising clients? And people, though they would be going ahead to file their DRHPs, don't take off the M&A options, depending on how the capital cap table is there.
Right. Anuj, one very quick point, and this is something from a retail investor's point of view. He spoke about the fact that a majority of the IPOs are PE-driven. There's also a concern that many of these issues are pure OFS.
I was about to come to
exactly.
that.
There's no growth capital.
The question I had in mind, and it's
Absolutely.
an open question.
Yes.
Any one of you can answer.
Yes.
I had an interview about 9 months back with Ramesh Damani. 9 months back or 7 or 8 months back.
Right.
He made a point that, he is afraid of the K-top. He said the Korean IPOs is coming into the market, and Hyundai came into the market not because they needed money, because it was an opportunity. A lot of this was opportunity capital. It was available for you. You just came into the market, you saw it, and you took it, and you took it home. Is that a fair criticism? Rahul, you want to answer that? Given that a lot of them have been OFSs.
Rahul and team worked on the Hyundai IPO, so he's definitely going to take that one.
I think it's an extremely important point. While a lot of OFS is there, a lot of secondary sell down is there, but it's only because the company at that point in time doesn't need the money. But the purpose of the IPO is not to take some chips off the table because the valuations are rich. It's not because of opportunistic only. It is also because as a listed company, the company then gets the ability to think about investments, whether it's organic or inorganic, with the revised multiple or the traded multiple. In the home country, if you're trading at, let's say in an MNC IPO, home country you're trading at 5x, India you're trading at 15x or 20x, then your decisions in India will be based on, if you're listed, based on the 20x multiple, if it's organic capex or inorganic. That is very, very important for a strategic call to be taken by a multinational. And same for different conglomerates or other companies as well. Access to capital is very important.
You're defending Hyundai, that it was right in terms of its IPO.
But even for other companies, once you're listed, the access to capital at any point in time with the traded multiple at that point will allow you to make organic or inorganic decisions, and that flexibility is where the IPO comes in, not just taking some money off the table through OFS.
Right, guys, it's time now to wrap up. Very quickly, Sarthak, we haven't looked at the sectors. in your perspective, from the SoftBank lens, which are some of the hotter sectors where you foresee that there will be IPOs being launched in the tech space? Very quickly.
I think we've got a large set of consumer tech companies that are likely to come. I know we've got stockbroking companies that are coming, and I think big winners for GV and Peak here. We've got few in our portfolio as well. So I think it's a question just a matter of time as pricing couple of quarters that we should see.
So consumer tech, GB, your list, top sectors to watch out for?
Yeah, I would say from an IPO perspective, new age and financials. You'll be surprised by, that you will see a uptick in financial IPOs in 25.
Right. GB, very quickly, your top picks?
Fintech.
Sorry?
Fintech.
Fintech. So fintech, consumer tech, financial services. With that, gentlemen and ladies, it's time to wrap up this very exciting panel. You've been a wonderful audience. I must thank my co-anchor, Anuj, as well, and all the rest of the speakers from the advisory and the investing world. Thank you so much.
Thank you.
Thank you.
All right, gentlemen, thank you so much for that. And all of you sitting in the audience right now, if you think you know markets, money and investments, you can put your knowledge to test now at the Moneycontrol Pro quiz. And you can also stand a chance to win exciting hampers. You can visit the Moneycontrol Pro booth now. With that, ladies and gentlemen, we will now take a break for lunch. Please join us for a delightful networking over lunch and recharge your sessions and insightful lineup after that. Also, we will resume after the break. Enjoy your meal.
Wants to know what's the best way to grow? Let's go. Go farther. So far ahead that the competition can't spot you, let alone catch you. And grow your audience's insight. Because stocks may go up or down, but knowledge is invaluable. Go. Assemble the A-team, the ones who reach the top, and then keep going. Go into uncharted territories. Blur the lines between media and technology. And watch as you make wealth grow. Go, build partnerships with the very best. And grow your voice, because the world needs India's perspective more than ever. Go into India's heartland. Speak her languages. Tell her stories. Grow her ambitions. Go, make a difference. Create a platform for policymakers, trendsetters, and change makers. Because the only way to grow is to grow together. We are Network 18, and we are always on the go. Enabling India to grow.
Welcome to Moneycontrol, your ultimate destination in the ever-evolving world of finance, business, markets, policy, and technology. India's preeminent news platform, driven by facts and fueled by data. A platform made in India, for India, and for the world. Moneycontrol.com has a staggering reach of 100 million plus monthly active users and 6.02 million daily active users. Being a transformative digital force, reshaping how we engage with money, markets, and news. Setting us apart is our commitment to delivering accurate information and empowering financial decision-making in a dynamic ecosystem. Seeking a deeper dive into the financial realm, we present Moneycontrol Pro, a powerhouse of exclusive insights, providing actionable investment ideas and expert analysis. Because in today's fast-paced world, informed decisions demand both information and expertise. And we have 1 million plus Moneycontrol Pro total paid subscribers and 100% return in 1.5 years, beating the market. Explore market trends, access expert opinions, and utilize essential financial tools all at your fingertips. Join the millions who trust Moneycontrol.com for their financial journey, where facts meet finance and data drives decisions. Think markets, think Moneycontrol.
How do you know that you've arrived? How? Is it when your name means many things to many people? Or when your signature becomes a currency? Or is it when the only approval you need is your own? Is it when you stand tall amidst giants? Just when and how do you know you've arrived? Tough question, babe. Because when you start to feel like you're almost there, a little voice inside says, the best is yet to come.
Let's make your next chapter the best one yet. IDFC First Private Banking. The best is yet to come.
I just love zero. क्योंकि मेरा बैंक जो है ना वो zero charge करता है.
जीरो? कौन हो तुम ब्रो? जीरो चार्जेस? ये तो हम सबको नहीं मिलता है.
नहीं मिलते थे ब्रो डिस्को के जमाने में. और मेरा बैंक जो है ना सारे सेविंग्स अकाउंट सर्विसेज पर जीरो चार्ज करता है. ओह. IDFC फर्स्ट बैंक में अकाउंट होगा
तो मोर मिलेगा.
हाँ. ये किधर से मारा तूने?
आपकी अलमारी से.
अरे चल ओरिजिनल नहीं है.
किसने बोला?
हाँ मैं बोल रहा हूँ.
मैं भी ओरिजिनल नहीं.
अरे
आई हैव टू लीव. बैंक में छोटा सा काम है.
अरे भाई साहब आजकल छोटे छोटे काम के लिए बैंक कौन जाता है?
You have any problem?
प्रॉब्लम तो है. मुझे नहीं आपको. आपको बार बार बैंक जाना पड़ता है ना. अब हम जहाँ बैंक वहाँ. IDFC फर्स्ट बैंक होगा
तो मोर मिलेगा.
पीछे कहाँ जा रहे हैं?
नहीं मुझे बोला गया था कि आप जहाँ खड़े होते लाइन वहीं से शुरू होती है.
The gold market has been evolving for decades, and the World Gold Council has actually been at the forefront of that development.
We provide data, research, and tools to investors that help them understand gold.
There is no comparable resource out there.
We have developed mandatory hallmarking in India.
Hallmarking is a stand of trust and transparency in the gold that people buy.
The role of the World Gold Council is to make sure that gold continues to be relevant. We are going to see a universe where every gold bar is logged in a digital database.
The benefit is to have one source and one form of gold tracked worldwide.
We are focused on only one thing. We're focused on gold. And so as a consequence, we are experts at it.
Bye.